morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live. Let's get right to the 3 things you need to know to start off your morning. First thing you need to know, the worst day of the year yet for stocks. All 3 major averages tumbling by at least 2% yesterday as investors were rattled by a surge in treasury yields and disappointing forecasts from heavyweight retailers. The move in yields was big. For 2-year treasuries, it was the highest since July 2007. For the 10-year, the highest since November of last year. As investors await the release of the minutes from the last Fed meeting, markets are now pricing in at least quarter-point rate hikes for each of the next 3 meetings. Second thing you need to know, after these big moves in the markets, you're going to get analysis from one of the best-known firms in the investing biz. Our Brian Sozzi has a day full of exclusive interviews from Double Line Capital in Tampa, Florida, kicking it off with Double Line Deputy Chief Investment Officer Jeffrey Sherman in just a few moments. The highlight of it all will be when we hear from Double Line's founder, CEO, and CIO, Jeffrey Gundlach. That's coming up at 3 p.m. Eastern Time today. And the third thing you need to know, Intel is slashing its dividend. In an effort to conserve cash, the company announced that it is lowering its quarterly dividend by 65% to 50 cents per year. In January, Intel had warned it would lose money in the first quarter as the PC market and data centers continue to take a hit after years of strong growth. The company is committed to cut $3 billion in costs this year. It's targeting $8 to $10 billion in savings by the end of 2025. Well, let's get on over to Yahoo Finance's Brian Sozzi. He's sitting down in Tampa, Florida for an exclusive interview with Double Line's Deputy CIO. Soz, take it away.
All right, thanks so much, Julie. Jeff Sherman, good to see you as always. The first investor meeting in this new Tampa headquarters, right?
That's correct. Yeah, welcome. Let me be the first to welcome.
Hopefully not the last one, of course, too. It looks like a packed room. So this is really the first turbulent patch for the markets this year. January was okay. We're seeing things really under pressure here. What is causing it, and how much pressure you think is likely to come here in markets?
Well, what we've seen is last year was one that was characterized by the inflation narrative. Obviously, one of the fastest hiking regimes of the Federal Reserve in the last 4 decades or so. And the year started off as just a reversal of everything. And the markets were so pessimistic last year. You got this little bit of a relief rally, but we went a little bit too far, too fast, as we all saw now with hindsight, right? And if you think about January, I mean, the bond market was up over 4%, right? You had stocks that were in the high single digits, right? Nasdaq was in the double digits. In fact, even after yesterday, Nasdaq's still kind of flirting with that double-digit return year to date. And so it's been this big reversal of trends. But what has changed in the last 2.5 weeks is really the market's starting to discount the whole idea of the Fed put again, right? And that they're going to pivot and that we're going to have this, reversion back to these levels of lower interest rates. And so the market's been fighting the Fed, right? The Fed has said they're going to be staunch this year. And all of a sudden now with some of the economic data picking back up in January, right? It was pretty abysmal in December. I mean, we saw retail sales come down. You saw the services data come in significantly. And then all of a sudden we get these strong jobs reports. There's a lot of controversy about the adjustments. Now we've seen the inflation narrative again change because of the BLS adjustments, right? So all of a sudden what looked like this glide path that the Fed was achieving, this path back to 2%, all of a sudden with these new revisions, they just add another 100 basis points to CPI. So I think the market is saying all of a sudden they maybe went a little too far, a little bit too fast. But right now, we're really kind of in the rates level we were back in November. And so we're not at the highs. The 2-year actually set a new high in this cycle yesterday. But that's really just pricing in the new Fed path that the Fed is talking about.
And what is that new path? I think up to a couple weeks ago, the prevailing thought in the markets, the Fed would maybe stop 5%, maybe a little bit over. Mm-hmm. Now I'm starting to see commentary, maybe 6%. Is it 7%? I'm not trying to sound outlandish here, but is that what the market is pricing in here? When do you see the Fed stopping?
No, not at all. What the market is pricing is roughly another 2.5 hikes or so. Maybe we get to 3, so call it 75 basis points. That would put us at a 5.5% rate. And the Fed has told you for the last 6 months they're going to 5. Right? The market fought it, right? And so what the dynamic in there, does it really matter if we go to 5.25 or 5.5%? I really don't think so.
Do you see 6%?
I don't see it at this stage. Okay. And I think what you have to see is a more persistent inflation. And the challenge is that you have base effects coming in that are going to bring year-over-year comparisons down. But what happened in this last CPI report is all of a sudden it came in hotter month over month. than the expectations. And so now there's this new question on whether or not inflation is going to stay contained. But probably the problem is that for all the hikes that we have in the marketplace, they're not really in the economy yet, right? We always hear about these long and variable lags, right? And then the Fed, even Chairman Powell's acknowledged them. But if you think about, the setup and usually how the Fed slows things, what do? They're trying to slow down the economy by slowing down growth, right? They're trying to make borrowing more expensive, and they're trying to incentivize saving. Well, if you think about borrowing, corporate America did a lot of it at very low interest rates, right? So unless you had to come to the market, you're not paying prevailing yields, you still have low coupon. Actually, the consumer, when you think about households, right? If you think about mortgage rates, everybody refied because rates were so low for so long. And so what you've seen is that this typical mechanism may not have actually hit the economy at this stage. So I think what this means is that we're probably going to have weakness more in the second half of this year as these things really start to materialize from the Fed's policy. But ultimately, I'm not convinced savers are enticed by this 5% kind of T-bill at this point. And the reason I think that they're not is because of the inflation. And most people in this country, your viewership here, they probably feel that inflation is significantly higher than what we're seeing. And that 5% maybe isn't enough to curtail their spending. So I think that these long and variable lags, which we never know what they look like, I'm afraid that they could be a little bit longer here. And so the Fed should be cautious. They shouldn't just push to 6-7%. I know Bullard was out a few months ago saying 7%. But I think what they need to do is be patient. But the one thing the Fed doesn't want to do is stop hiking and have to restart hiking again.
Well, then that raises, I think, the discussion, is this the Fed that has sown the seeds for a recession in the second half of this year?
I don't know if it's the second half. It's going to definitely become more challenged. It may be a 2024 issue.
So 2024 potential recession.
Yeah, that's
Bad
what
recession.
Well, we don't know what a recession looks like, right, at this stage. But the thing is that there's been this resiliency in labor. You and I were talking before here too. The service side it just continues to really show more job growth, and so we know labor is a lagged variable. We know that it's the last thing to kind of drop when you talk about the economy. But ultimately, what does a recession look like? Right now, where's the weakness? Right? There's a little bit in some parts of the housing market, some of the commercial real estate market, but in general, you're not seeing it in the economic data. And so thus far, it's kind of bucked the trend. But remember, it was extremely pessimistic in the fourth quarter, right? I mean, coming into this year, I think, what was it, like 60% of Wall Street, the economists, had a recession in the forecast. In my career, I don't remember seeing like 10% ever saying that. So I think what it is that it's this policy. We're used to the Fed inducing recession. They will likely induce one again, but it's the timing that's really not unknown. But for right now, the economy still looks okay.
As a firm that focuses on bonds, how concerned are you about the debt ceiling debate? How destabilizing do you think that could be in the back half of this year?
I'm not really that concerned about it. And the reason I'm not that concerned about it is because if you plot the total debt outstanding of the government and the debt ceiling, and you go back over the last 40 years or so, those lines are indiscernible. Right? We always just bump to them. The difference is now is Congress feels more contentious than it's been. But what will happen in that area, if we get to the point of where we're talking about a default and you're shutting down the economy, right, and you cause pain to the American population, they're going to complain to their Congress people, right? And that's what will get things done. So I think it's grandstanding at this point. I think the whole McCarthy thing, it was just big grandstanding.
So you are not positioning for a default. You still think that gets kicked down the road, and that's how it goes.
Yeah, because ultimately we have a printing press, right? We can satisfy our debts if we choose to. If we don't choose to, it's a whole nother issue, right? And then you jeopardize the overall economy as a whole for what? Right, at this point. And so, yes, we're ingrained in this mandatory spending. It needs to change, but the whole idea of the debt ceiling being an issue, it just hasn't been. And like, if you look at the Treasury market, it really isn't priced anything at this point, because we've seen this story before, and it usually plays out that it's 11th hour negotiation. And again, it's grandstanding usually at the end of the day.
DoubleLine has a massive following on the Yahoo Finance platform, Jeff. Everyone is always very keyed into what moves you're making. For this average investor universe that is on our platform, how do they position their portfolios in what might be a volatile few weeks?
Yeah, well, I think right now, like, hiding in T-bills is not a bad trade, right? That's not talking our book, right? You can go buy them directly from the government, right? You have a government money market fund out there. And so I think it's important to realize that what you were clamoring for 18 months ago was yield. It's everywhere today, right? And we've had a backup in rates. And so at this level, rates look pretty attractive because we do think that although inflation does remain above Fed target, right? The Fed's targeting 2, we probably get a 4 handle this year in inflation, but that path will slow over time because all of this Fed-induced hikes will slow things down over time, which will also slow the inflation side down. So ultimately, we think that upgrading quality in the portfolio, which is kind of a cheap thing to say, but what that means is you don't want to be owning as much high yield at this point. Bank loans are causing us a little bit more concern.
Why is that?
Because they float. So all the benefits that the investor gets, right, of the floating rate coupon, right, the lender itself actually has a problem, right? Because all of a sudden now you're this company that had all this floating rate debt. Well, now you're paying 5% more in interest. So as an investor, you receive a higher coupon, but the burden goes to that. So those benefits I talked about at corporate America, like in the investment grade bond market or in the high yield market, are actually the antithesis in the floating rate market, right? It's more costly, it can be more problematic. So I think that investors should be cautious of that part of the market today. I still think, again, where we are in the cycle, I think owning some credit is okay, but I don't think you should be out there extending your risk budgets, right? And so what we've been doing, in fact, we've been buying rates on this backup lately. We've extended what we call the duration of the portfolio, the interest rate sensitivity, and we're doing that by buying treasuries. We're not buying T-bills, we're buying longer treasuries out there. And we think that that is the right thing to do at this point in the cycle because it gives you, if we have that recession risk and it hits us sooner than we think it does, it gives us the chance to make a lot of money on that side, right? And again, if our credit goes down, right, the treasuries can offset that. So for a typical investor right now, I think what you should be doing is really thinking about the fixed income portfolio and what it can offer you. If you're worried about this noise and the choppiness in the next few weeks, look, sit in a money market account for a little bit, but you have to have a plan. When do you buy the market? And having a 10-year treasury above 390, approaching 4%, looks pretty appealing. Remember, Brian, 18 months ago, the high yield bond market didn't yield 4%. Mm-hmm.
And I know the firm has also pushed into ETFs. Is there a safe way, or how should investors be doing that? How do they play some of these ETFs in a volatile market? Well,
I mean, ETFs are just an investment vehicle. It's just like a mutual fund. It's just another choice. And so the nice thing about the ETF is you have intraday liquidity, unlike a mutual fund. So it allows investors to get in the market at any point during the day. But I think they're just trading vehicles like anything else. You're trying to express a strategy. And so, I've always questioned whether or not, does an investor need to have intraday liquidity on a fixed income portfolio? Because you don't think about that as this massive trading swing, but it has been in the last year or so. And so our push into ETFs is because our investors have asked for it from us. And so it's not something new to us. We have a relationship with State Street under the Spider brand. We've been running ETFs under their platform since 2014. So this is not something new to us. It's just we have it under our umbrella as well. And so it's because of the client demand that we created the products.
Last one for you here, Jeff. Yield curve inversion. Do you view that still as a great recession indicator?
Yes, ultimately. But I don't. But the problem with and why I say ultimately, it doesn't say the recession's imminent. What I glean from the yield curve inversion today is that the bond market is telling the Fed they are too tight. That is what the bond market is saying. So we can argue whether or not it's recessionary or not in the short term, but the bond market is fighting the Fed. It's saying you are too tight with your policy and you are going to have to relent at some point. But the thing is, with this last rate sell-off and yields going up, the entire curve has moved almost, pari passu or what we call a parallel shift. And so ultimately, I think what you're seeing there is it's the bond market saying the inflation is going to come down. We're seeing that in some of the data. Yes, there was an uptick in 1 month-over-month number, but ultimately the bond market's saying you will not stay there throughout this cycle. And so the Fed is going to stay put. They're going to get to a level this year. They're not likely to cut rates, and the bar for them cutting rates is significantly high. They must fight inflation. Listen to Jay Powell talk every time he has a press conference. That is his number one mission at this point. And so regardless if they have to throw us into a mild recession, that's what they're kind of hoping for. And what's a recession at the end of the day? If we have house prices go down another 5-10%, is that a recession? I don't know. A recession should be broad-based. And so
sounds like it would be an opportunity for me to finally own a home.
Yeah.
Maybe that'd be good.
I mean, there's nothing wrong with that. And so, look, at the end of it, house prices went up, from the nadir of the pandemic to the peak. They went up nationwide almost like 45%, right? And that was like 2 years, right? That's too much, too fast. We overshot. That's like a lot of the economic data. And I think that's what you've seen. It's been a challenging year last year with the economic data as well, because these overshoots to the upside, well, guess what? You get overshoots to the downside as well. And so, again, our recession indicators don't say that it's imminent, but they say you should be on alert. You should start building the position, which is why we're starting to buy more treasuries into our portfolios. It's simply to try to start planning for that. And look, if we're wrong, guess what? All of a sudden, we make 4% on our treasuries. It's not a bad trade.
It's always good to make extra money. Jeff Sherman, DoubleLine, Deputy Chief Investment Officer. We will let you get back to picking trades. That's what you do here. Get back to work. We'll talk to you soon.
Thanks, Brian.
Back to you guys in New York.
All right, thanks so much, Brian. Appreciate it. We'll have much more from Brian Sozzi in Tampa, Florida, as we go on throughout the rest of today. But we got to get to one other thing that we're watching here today, and it's kind of yesterday's activity. As yesterday, we saw the major U.S. indices have their worst day of 2023 Tuesday, while Treasury yields surged, adding to investor concerns there. Fed officials will release minutes from its early February meeting later today and give a glimpse of how high interest rates could go here. Now, of course, Julie, as we think about this is backwards looking. This is the meeting minutes for the meeting that took place January 31st through February 1st, and ultimately we got a decision. But since then, we've got even more economic data that's really unveiled continued job gains that we saw in January. Of course, that did lap some kind of seasonal trends that we typically see in a January report. But we also saw inflation slow down less than expected in the most recent CPI reading. And then we're waiting for PCE to still come forward here.
Well, and we've also had a couple of non-voting members of the Fed say they saw reason to raise by 50 basis points, by 0.5%, right? And even though they're not necessarily representative of the whole, they're not representative of the whole, we know, because that's not the decision that the Fed made. But people are going to be looking in the minutes to see if there were any voting members of the Fed maybe who were leaning in that direction. As it is, we're now seeing the market price in 3 more quarter-point hikes at the next 3 meetings. Some people are even looking for 0.5 point increases at one point or another. So that's really what's been spooking the markets over the past few days. We are seeing a bounce back from those levels today, but that could potentially change when we get the minutes out later today if the perception is flipped on its head once again. We've got PCE later this week as well, which could again throw some wrenches into that equation. So there's still a lot of questions about what the Fed's going to do.
Yeah, within that transcript, it'll be interesting to see to what extent there was at that meeting a little bit of Fed fisticuffs, if you will, in terms of the tenor of the discussion that was taking place there and the policy perspective, and to what extent that carries through to that March 21st and 22nd meeting as well. In the meantime, though, in this kind of bounce back that we had seen in some of the more risky assets that were out there in the market, that we had seen in consumer discretionary, XLK as well, in technology even, those have been still up year to date in a sector performance basis. XLY, consumer discretionary, up by about 13% year to date. That's seen a little bit of a pullback over the past few sessions as investors get a little bit more of that inclination to parse through what some of the details were and the Fed speak that had emerged, as well as XLK, technology, seeing a little bit of a pullback in recent sessions too here.
Speaking of XLK, speaking of tech, let's talk about Intel. Intel is slashing its quarterly dividend by 50 cents annually as the company looks to conserve cash amid economic headwinds. It's coming after the chipmaker warned of losses to come in the first quarter and pledged to reduce its cost by $3 billion this year. We also, the last time that our Brian Sozzi talked to Pat Gelsinger, the CEO, he said he was committed to the dividend. So it's not, but that said, it's not a huge surprise that we are seeing this move given some of the troubles that Intel has had. If you look at the quarterly basis now, the dividend's going to 12.5 cents per share. It was something like 36.5 cents a share on a quarterly basis. Yeah,
so slashing that by about 2/3 on the dividend basis there. They're also cutting compensation, reducing some other operating expenses, the company talking about. And in a quote in this statement, the CFO, David Sisson, Wisner of Intel saying that in the fourth quarter, we also took some of the steps to right-size the organization, rationalize investments. This is on top of what they had already initiated in some of those cost-cutting measures, including the headcount reductions there. It's important to remember what their long-term targets here are on the cost reduction targets, $3 billion in 2023, and then achieving $8 billion to $10 billion by the end of 2025. Also comes at a time where they're spending a lot of money that they've either partnered with the likes of Brookfield, and there's going to be another partner that they've teased as well on bringing some of the capacity up to speed for fabrication processes and foundry services. And so with those dollars, combined with the government dollars that have been earmarked for bringing more chip capacity online, that is where more money is continuing to go out the door for Intel and where some of those costs are being restructured to prioritize what the future of the company and that next leg of growth could perhaps look like.
Yeah, one thing to mention as well, the company did not change its forecast today for its first quarter. So even though it's cutting the dividend, reiterated its forecast for the current period. Well, U.S. equities have been weakening against a backdrop of interest rates that are once again surging higher. So was the rally to start the new year as good as it's going to get? Or was Tuesday's move just an overreaction? You can read all about that in today's morning brief over at the Yahoo Finance homepage. For more, let's bring in Callie Cox, eToro U.S. investment analyst, and Yahoo Finance's Jared Blucher, who wrote that very same morning brief. Jared.
Yes, with the help of a few choice quotes from Callie here. And Callie, one of my points is we've seen a different character to the rally this year, which was, before yesterday, the best start to a year since 2019. Let me sort the Nasdaq 100 components by performance. Up in the upper left here for this year's performance, Tesla followed by Warner Brothers, 60%, 55%. Then you got Airbnb, Lucid, Align, Meta, 43%. And then you take a look at the one-year performance here. Some of the biggest losers here, Lucid down 62%, WBD down 50%, and Meta down there as well. Some of the biggest losers here were last year's laggards. So tell me what you're writing about in terms of quality and what you're seeing in the market, please.
Yeah, well, Jared, I think you nailed it. We've seen a flip in fortunes when it comes to quality versus risk, quality versus growth. And it's a little weird. At first it was justified. We did see yields sell off quite a bit at the beginning of the year, but now yields are rising again. We're worried a little bit more about inflation, yet we are still seeing tech outperform. So that's making us a little cautious.
Yeah, and we were just taking a look at the 13-week T-bill yield. I'm going to put a chart here. This is over the last 3 months. From the lower left to the upper right, but it's really gotten a spurt this year. And you supplied me with a chart that you're looking at. This is the Nasdaq 100 earnings yield in green and the 10-year Treasury yield. And guess what? They have now converged all the way over here on the right-hand side of the chart. So what does this tell us?
Yeah, so I think this is the most powerful chart that you can show when it comes to thinking about, where tech is and where rates are. Now, like you said, Jared, this is a chart of the Nasdaq 100, the tech-heavy Nasdaq 100 earnings yield, which is basically the price-to-earnings ratio flipped on its head. It shows how much you can expect to generate based off of earnings for tech stocks.
And with stocks, you would think you're taking on a bit more risk than a United States Treasury bond or note.
Yeah, but you're expected to make about the same return, which seems a little off. It seems a little off balance. And as you can see, historically, you don't see that happen much.
Yeah, in fact, we did see this happen way back in the global financial crisis, and we saw some more things unfold from there. So what are you advising clients here over at eToro based on what we've seen so far this year? Maybe a little defensiveness?
Yeah, so, our clients, we are a retail brokerage. We have clients who are a little more speculative in nature. So we're just telling them to proceed with caution here. A lot of them have favored those, high growth tech stocks. A lot of them are crypto curious or have crypto in their portfolios. And I think that there are a lot of interesting trends going on. Maybe if you are longer term, maybe this is a time to step in and take some risk if you're feeling it. But, at the same time, this rally just hasn't matched up with yields as much as we expected at the beginning of the year. So we're telling them possibly hedge those tech positions. Look at multi-directional trades if you want to take this as an opportunity, and remember that we're still not out of the woods with inflation. Right. And as long as we aren't, the Fed is going to keep rates high. All
right, real quick here, we got time for one more. The Fed minutes today at 2 p.m. What are you expecting?
Oh man, I'm expecting an overreaction probably.
All right.
The market's reading way too far into them, but we're all nervous about where rates are going to go, and that comes straight from the Fed's mouth. So I'll be watching closely. Hopefully we don't see too much volatility.
I'll be watching Bitcoin here. Bitcoin highly levered to the Fed's balance sheet. All right, with that, I'm going to toss it back to you guys.
Thanks so much, Jared, and thanks, Callie. Really appreciate you guys. That was really interesting analysis. Thanks a lot. Later on in the hour, we're going to discuss the winners and losers of 2023. We're going to pick up on some of the themes that we just heard Jared and Callie talking about, and that conversation will be with RBC Capital's Amy Wu Silverman. Plus, on the other side of the break, Palo Alto soaring with revenue getting a 26% boost year over year. We're going to break down that report, plus have the opening bell on Wall Street next. Now to some movers that we're watching ahead of the opening bell. Looking at Coinbase, which is up a little bit this morning. The fourth quarter revenue did beat analysts' estimates despite a 75% drop from a year ago. So big deal that they beat. They dropped 75% from a year ago. Trading volume was down 73% year over year. Frankly, Brad, I'm surprised to see this stock higher at all. These results, I mean, I guess people think things are going to get a little bit better. Assets down 71%. From a year earlier, Coinbase is not doing great.
Show me those people that are thinking things are going to get better right now with Coinbase, quite honestly, because you have a lot of the street right now. Cowen, out earlier in our Brian Saws, they sent us this note earlier today. Cowen saying, remain cautious on structurally higher costs and policy chaos versus previous cycles here. Coinbase addressed all of those things, whether on the regulatory front or on the end user front on the earnings call. They generate most of their transaction revenue today from the retail customer base. That's one thing. They also, in their subscription product, they're going to be ramping up, trying to drum up more demand so that people buy into that experience. And so they believe that fees, they're going to compress in the near term due to commoditization. They have yet to see that in crypto. And they think that after 2022, there's more value placed on a trusted platform and a regulated compliant approach is what they're banking on there. But that regulated compliant approach could also be a disruptor or a net detractor for their business in the near term, depending upon what it looks like, because they're still looking for answers themselves. They just submitted a letter to the SEC.
The company did say first quarter subscription and services revenue will be $300 to $325 million. In the last quarter, it was about $210.5 million, if I'm reading correctly here. So, I don't know. I mean, I guess that would be a little area of improvement perhaps, but to your point, besides that, there's not much else to be found in here that is super positive. Fourth straight quarterly loss for the company. So that's Coinbase.
Yeah.
Let's talk about the opening bell and the setup for today. We are seeing a little bit of a bounce back here to set off the Wednesday session on this holiday shortened week here. And obviously there's still a lot of concern about what's going on with the Federal Reserve, what's going to be happening with interest rates, but all of that, it seems like the market's taking a brief pause from as we get underway, at least until we get the minutes later this afternoon, PCE later this week, as we just heard Callie Cox of eToro saying markets are going to be reading in very, very closely to those minutes to figure out what they mean. I'm looking up Strawberry Fields here.
Yeah?
Yeah, Strawberry, it's a
Tasty
REIT.
way to start the day.
It's a REIT, apparently, based in South Bend, Indiana. Not a Beatles song, not an area in Central Park named after the Beatles song in memory of John Lennon, but rather now it's a REIT.
Yes, a company that trades on the strength of soil out there, Strawberry Fields.
Guess so.
Yes, taking a look here at the Dow Jones Industrial Average out the gate this morning. You're seeing that just barely to the upside here. And let me load up the chart for you. As over the past 3 months, net lower by about 2.7%. Intraday here, we are higher by about 0.1%. Of course, that's out the gate. Let's put this on a 2-day view so you can get yesterday's move in context as well. We're still net lower, given yesterday's move lower by about 1.9% in aggregate. We are still lower over the past 2 days, despite the move higher out of the gate slightly here this morning. Nasdaq Composite also a fractional move to the upside. That's up by about 0.3% right now. But yeah, you guessed it, still down by about 2.2% over the past 2 days this week as the market really gearing up for what could come to light from some of those Fed meeting minutes from the FOMC once they drop later on today. You're taking a look at the S&P 500 flat just barely to the upside by hair on its chinny chin chin. However, still down over the past 2 days by about 1.9%. I want to take a look at some of the sector activity on that aforementioned S&P 500. We've got 11 sectors. All of them loaded up here on the screen for you. And as of right now, XLE pulling up that caboose. It's down by about 0.5%. However, leading the pack right now, actually some interesting activity out of the gate from consumer discretionary. That's up by about 0.5% here on the day. And as I mentioned, that is one of the better performers over the course of this year thus far. A little bit of a bounce back from 2022's activity. I do want to take a brief look at retail as well here. We've had some interesting moves, both on the earnings front over the course of this week. You got that yesterday, kicking things off from Walmart and Home Depot. However, we had some more news come out from TJX. That, I believe, I saw that moving higher earlier this morning. We'll see if we can find it quickly. Actually, no, now it's down by about 0.9% here on the day. They actually did top some of those same-store sales estimates, so that was in focus. And then one other item, Bed Bath & Beyond, also going to be delaying some of its payments. Hey, there we go. Yes, thank you. That is higher on the day by about 2.9% for Bed Bath & Beyond.
Sometimes it helps to be further away from the screen. So you're just going to stand back.
I see. This is a better view. Yeah.
Yeah, there you go.
I agree.
It's helpful.
It's not the best for the viewers, but hey.
That's all right. That's all right. Sometimes we gotta take a little step back. Let's talk about another mover, Palo Alto Networks. It is pushing higher by 11% this morning after beating expectations for the second straight quarter. The cybersecurity company seeing revenue and billings each grow 26% year over year. And this really continues the trend that we have seen mostly among cybersecurity, which has stood out above the enterprise software pack. With strength in this reporting season. According to Piper Sandler, the quarter ticks all the right boxes. The company continuing to show strong execution. So that seems to be definitely part of the deal here, and that companies, clients are sort of buying what they're selling in terms of that cybersecurity needs to be a focus for companies right now.
Yeah, absolutely. And you were mentioning one of the calls there from Piper Sandler. The street's really been active on this name this morning. Wedbush also saying that this is a solid quarter. And of course, Dan Ives, leave it to him to come up with a solid metaphor here. Solid quarter and outlook, an Aaron Judge-like performance here. So for all the Yankees fans out there, price target 210 there. You also got a price target of 220 over at Citi. They reaffirmed their buy. They say that it's a healthy beat, and the guide was a touch mixed, but defensively prudent, and it validates some of the three interrelated dynamics for cyber in calendar year 2023. Won't go into all of them, but you're seeing the stock react here on the day, net higher by about 11% as of right now.
Yeah, and building on some gains of the year, it's up something like 20% now for year to date.
Huge year for cyber here. We'll continue to track that. Also tracking Baidu, that's out with a beat on its latest quarter earnings as it unveils a $5 billion share repurchase program. Shares of the web services company surging to the upside. But here's one interesting thing. If you're thinking that this is new, that the company classifies themselves as an AI company, it's not new. I was looking into when they actually did some of that repositioning, as we're hearing artificial intelligence come up in just about every earnings call in anything touching technology, and something's not touching technology here today. It was pre-pandemic, just barely pre-pandemic, that they made the switch and said, you know what, we've made so much investment in AI, and it's starting to show up in their business. I think investors rewarding that and really taking note of that as well. So it's kind of as Sugar-Free, the artist Sugar-Free would say back in the day, if you stay ready, you don't have to get ready. And that is the case here for Baidu on the day with its AI play.
Well, it's not clear to me, though. Okay, so they have this Ernie bot, right,
Yes.
which is their AI technology. But I can't figure out if the Ernie bot is comparable to an Alexa or to a Siri. I mean, those are AI too.
Sure.
Right? Isn't that considered AI?
But I think it's how they're fusing it into search.
Well, I don't know if Ernie is the next generation sort of generative AI or if it's the old school. I don't know enough about it to be frank. But the company did say it's going to plan to fold their Ernie bot into its smart speaker and into its video service, IXIC, which is another publicly traded company as well. So it's definitely talking up the AI aspect of it. It's going to also integrate Ernie into its autonomous driving platform. So Ernie everywhere.
Ernie's going to have to learn some new languages then. In the world of artificial intelligence, languages and modeling, Ernie's going to become well versed in a couple of
Driving.
things. Yes. Search.
Yes, all that stuff.
All the things. Guys, good for you, Ernie. What's next for Section 230 and why you should care? We're going to discuss that next.
The Supreme Court hearing arguments in a landmark case that defines how content platforms handle user content. At stake, how much platforms can moderate users' posts and whether they should be held accountable. Supreme Court justices so far appeared split on the issue as Google presented arguments. Yahoo Finance's Alexis Keenan was there at the Supreme Court yesterday.
Got to see the action, yeah.
Tell us about it.
So that was one of two cases the Supreme Court is hearing yesterday and today, and they both are near mirror images of each other. In both of these suits, they challenge Section 230 of the Communications Decency Act. It's a 1996 law that shields what's called interactive computer services, and what we think of there as social media and other platforms that allow third parties to exchange information, make comments, and socialize. That's what these cases are about. What that law does, it keeps the companies that are the platforms immune from being held liable for what other people say on their platforms. So both of these cases, they arise from ISIS terrorist attacks. The plaintiffs here, they are victims, the estates of victims suing Google, suing Twitter, suing Facebook, saying that these companies should be stripped of their 230 immunity in certain cases. And they say that's because they shared and promoted videos, content to ISIS sympathizers that then led to these attacks. Now, one of the cases, that was yesterday's case against Google, and in this case, YouTube is the one being sued here. The plaintiffs said that they should lose their immunity in that case because YouTube's algorithm recommended content to the people who eventually watched these videos and sympathized with ISIS. Now, the other case that's being heard today, that one is against Twitter, Facebook, and Google collectively. They say that in that case, 230 shouldn't apply and the immunity should be stripped because the companies failed to block harmful content, that is. So in both cases, they're saying that these videos or these shares of social media that this is other people's voices, what other people said, that if these companies amplify it and they promote it, they put it at the top of search, for example, that's the thing that should separate whether there's a recommendation being involved or whether it's just purely a neutral kind of serving of information when a search is performed. Google's position is that there's no way to draw a line here, right? You can't draw a line between a company attempting to sort and actually what is a recommendation. They say if Congress wants to change Section 230, that is their purview. It should not be before the Supreme Court.
The Supreme Court yesterday, if you read a little bit, and of course you were there, about like the justices questioning, they seem to be really zeroing in on little technical parts, like was it in a thumbnail that they were recommending stuff? Like, is that stuff going to be really pivotal eventually?
It may be. It was highly technical. And keep in mind that in the Google YouTube case, the plaintiff's argument, and the Biden administration is also making arguments in this case that 230 should be narrowed for a little bit of a different reason. But the thumbnail issue is part of an evolving argument on behalf of the plaintiffs. And the reason is it's because it's so difficult to decide where is that gray line. And so they decided that, well, it's when Google or YouTube generates a thumbnail, and now that's Google, YouTube speaking. That's not the third party speaking anymore. They are generating content, they're amplifying, they're serving it up to users, and they say that is where the line should be. The justices not necessarily buying that from both sides of the aisle. They were challenging
this. It seems like the algorithm is that already. The algorithm is something that YouTube generates. Anyway, go ahead, Bruce.
Well, no, it just begs the question of what material changes then these platforms would have to make and how that would so disrupt the user experience that is already present that they've been able to monetize to this point as well.
Right. So one of the plaintiffs' contention is that the internet has changed, that the model is now an advertising-based model, and that's what's causing these companies to boost up videos that are harmful, whether they're third parties speaking or not. So that is something that is a very difficult challenge, but look, these two cases, they absolutely could make sweeping overhauls to the internet and the liability. And if you just look at Google's 2022 ad revenue alone, almost $225 billion. Carve out YouTube there, you have $29.24 billion for 2022. These are major stakes in both of these cases that we will be closely watching.
Yahoo Finance's own Alexis Keenan really teeing this up and tracking this boots on the ground at the Supreme Court. Thanks so much for keeping tabs on this. This really tees up our next conversation as well. At the heart of Section 230 is the issue of content moderation. Content platforms, including social media companies, could make some big changes if they're made to assume responsibility for their users' posts. So, Julie, Why should I care about it?
Well, I mean, everybody who uses the internet should care
Yeah.
about this, right? Section 230 has been a hot topic of discussion, not ever since it was created, but almost, right? It was part of the 1996 Telecommunications Act, really in the early days of the internet, and based on some court cases that happened around that time. And as Alexis was just talking about, it is designed to protect the hosts of content from being held liable for that content. So here's the text that was in Section 230 that really everybody talks about. No provider or user of an interactive computer service shall be treated as the publisher or speaker of information provided by another information content provider. In other words, if I type something on the internet and send it out there, or post a video, etc., the host of that content cannot be held liable. That's basically what this said. So just to put a little bit of a fine point on it here, if you talk about the analog world, the world in which I am standing right now, and you look at some things that are like that. If, for example, I'm a bookstore, or I own a newsstand, I cannot be held liable for the books that I sell or the papers that I sell at my establishment. That is precedent in some court cases where the Supreme Court or other courts ruled that if I have, for example, what is deemed an offensive book that I'm selling at my bookstore, I can't be expected to know the contents of every book in my bookstore or every newspaper on my newsstand. So that's what precedent had said. So they are not liable for speech or for speech that is seen as offensive. Publishers, however, can be held liable. So if I publish a book that is deemed as offensive, or if I publish a newspaper that has libel, for example, or lies about someone, or knowingly something that is factually incorrect, I can be held liable. And then, so in this analogy, basically online services are more like the booksellers or newsstands. They disseminate the information, but they do not publish the information. So those pushing for changes to Section 230, that is effectively what would change. If Section 230 goes away, why should you care? Well, it can mean big changes for the internet here. Alexis was just talking about this somewhat as well, that there would be a lot more liability for the likes of a YouTube or Twitter or Facebook, what have you. So what could happen? Well, some social media sites might say, we're going to get rid of moderation entirely because that way we're not making decisions on what speech is or is not. So sort of take a hands-off approach. On the flip side of that, social media sites could drastically cut down on certain types of content. For example, there was a new law put into place in 2018 that gave new tools to authorities who were cracking down on sex trafficking online. So Craigslist, for example, in advance of that law, got rid of a section of its website that perhaps, even though, of course, it wasn't designed for that to have sex trafficking, but critics said that it was a place where that could happen. They got rid of that part of the site entirely. So we could see more changes like that, Brad. It's sort of, it could go in one direction or another. There's some other changes that could happen too. But of course, it might not be that Section 230 gets scrapped entirely. Congress, as it's talked about for a long time, could rewrite the law or come out with another version of Section 230. As I said, they've talked about it for a long time, but they haven't done anything.
You've convinced me. I officially do care a lot now. Thank you so much. That's our own, of course, Julie. Yeah, she's coming back to the set in a second. Guys, coming up, we're going to break down the year's winners and losers so far with RBC Capital's Amy Wu Silverman. You don't want to miss it next.
There's a familiar stock on Yahoo Finance's trending ticker page this morning. It's AMC. 2022 may have been a bad year for names like AMC and other contemporaries like Carvana and Peloton, but 2023 so far has been giving them some upside. One strategist thinks that rebound is temporary. Here's a look at some of 2023's winners and losers and whether they're going to continue to be with Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. Hey, Amy, good to see you. So you call some of these names trash, to put it simply. Do you put AMC and some of those others I mentioned in that category? And how do you think they're going to continue to trade here?
Yeah, it's a good question. I guess that's not very nice, is it? But we do have a more quantitative way of looking at it. We essentially call those names our low quality basket, so this is kind of agnostically sweeping through liquid option names. Who has negative free cash flow, who has leverage, who has debt in a rising rate environment, who has negative net income, and unfortunately, AMC, GameStop, Carvana, all these names that I think everyone became quite familiar with in 2020 when stimulus checks went out. Those were the losers of 2022, but they have really rallied sharply in 2023. But the fundamentals haven't changed. These are still low quality names facing what is a pretty abrasive environment ahead.
So what, within this move that we've seen in 2023, early days at least, for those names that have been rattled, the fundamentals hadn't changed over in 2022 and they declined precipitously, to what extent was it just investors buying on hopes of a rebound or a bounce off of some of that move lower, or perhaps even a short squeeze in some of those instances?
Yeah, look, I think the technicals in particular in the beginning of the year has a lot to do with the action we saw year to date. Tax loss harvesting and then rebuying back into the market is also related to that. Another thing is just simply when you look to participate in leverage, you go with the momentum first. And one thing that we saw that was really unique about 2022 is essentially hedging stopped. So investors didn't buy downside protection. Skew became very low. People kept asking me, what is going on? We don't think that the market environment is great. So why is skew essentially disappeared? My answer was when cash yields 4% and you can park it there, you don't actually need those hedges in the same way. So this may sound a little counterintuitive, but skew has actually returned to the market because people have kind of started to wade back into the pool. So you can view it as concerning in the sense that people are starting to protect what they have, but also it means people are participating more in the equity market than they were kind of towards the end of last year.
Well, and if they're hedging also, doesn't that imply that if they're protecting themselves, isn't that a positive thing? In other words, wouldn't the downside maybe be less than if one of their trades didn't work out?
Yeah, exactly. So for those who are participating, obviously you're kind of ameliorating that downside, but it does kind of mean that cost of protection starts to rise for everyone else. And then the other thing I would say is, in the options market, it gets a little muddled, Julie, because there's sort of the short term where we look at anything from 1 day to 1 month. And then there's what we consider the long term, so 4 months or even longer. And those still tell two quite different stories. So longer term, there is a lot of that hedging, but you don't see that as much short term. You actually see a lot of this kind of craziness with zero data expiration options, crazy volume there, as well as this bid for upside. So people trying to get into the market rather than protecting it, which is what we see longer dated.
So kind of early year, we were also looking at, on a sector front, discretionary, consumer discretionary, as well as the bounce that we've seen in technology. What would you say of that? And is that kind of expected to continue? Is that something that you expect to wither on the other side of that?
Yeah, to be quite honest, it's a really difficult question. And part of the reason is, when we looked at our trash basket, our low quality basket, whatever you'd like to call it, a lot of the names that were on it in terms of airlines, cruise ships, all of these were related also to the China reopening. So you have a name like Wynn, which obviously benefits as the casinos reopen. You have airlines as people start traveling to and from China. And so there was this bump because, everyone expected at some point that China was going to reopen. We were really uncertain about the time. And I think it essentially came earlier than investors expected and way more full force. People, I think, were expecting something more gradual. The question we're contending with now is how much of that has been priced in. And you're left with these stocks that have done quite well, but they remain low quality and they remain quite leveraged. And how does that look going forward?
So if we look out to 2023, we talked about a couple of things that you're expecting: hedging demand already coming back, what's going to happen with these low quality stocks, to put it a nicer way. And then finally, what's going to happen with volatility as we head throughout the year?
Yeah, so, I think volatility really, really surprised a lot of us last year. But I do think this year is going to be a little bit more of the year of normalization. So what do I mean by that? First, we are going to start to see VIX hit that psychological 20 floor that tends to happen in higher environments of cross-asset volatility. So, rates vol remains extremely high, FX vol remains extremely high, and you are seeing that return of hedging. And then the second thing I would see is there has been this focus on, people call it Volmageddon, but essentially this focus on very, very short-term options, these zero-data expiry options. I actually think that focus lessens and you pay much more attention to the larger hedging story, which is much more long-term. And by long-term, I kind of mean the 3, the 4, the 6-month territory.
Long-term in the options world, right? Amy Silverman, thanks so much. Head of Derivative Strategy at RBC Capital Markets. Good to see you. Thanks, Amy.
Good to see you.
Coming up, we're going to check in with Brian Sozzi from that Double Line conference in Tampa. That's next.
New office in Tampa. The investors are pouring in, getting their breakfast and coffee on. Also prospects coming to this meeting as well. Spending the whole day with the Double Line team, getting their most recent thoughts on stocks, markets, ETFs, and of course housing. Jeff Sherman, the deputy CIO, kicked off our coverage at 9 a.m. really with some interesting thoughts on recession and interest rate risk. I believe you can find that clip now on the Yahoo Finance homepage. Our very own Alexandra Semenova writing that story up right now and taking us behind the scenes of what Sherman said. Coming up for me, though, here, folks, Monica Erickson, double line investment grade corporate credit manager, will be on with us right out of the break here. Talk about the outlook for corporate bonds against the backdrop of rising interest rates. And we'll be right back.
Welcome back to Yahoo Finance Live. This morning, I am Brad Smith alongside Julie Hyman here in studio in New York City. Markets trying to find some footing following a broad-based sell-off to start the short week. We're going to take a look at the three major averages here as we are 33 minutes into the start of trade here on the day. Well, 34 now. Dow Jones Industrial Average right now still holding on to gains. It's up by about 0.1%. Take a look at some of the intraday activity here, and we'll put this on a candlestick view for you. We've had some downward momentum, at least in those past two candlesticks from the late 9 a.m. hour into the start of the 10 a.m. hour. We'll keep a close eye on that. Intraday net higher, though, by about 0.1%. Fractional move higher on the Nasdaq as well. You've got some red candlesticks emerging there, too. So we'll continue to watch that. However, still net positive in the S&P 500. Seems like there is a lot of downward pressure that is persisting here, at least right now, within the first and early moments of trade here on the day. We've still got a lot of time left, but all markets certainly waiting for that data or those meeting minutes to come out from the Fed to get a little bit more insight into exactly how the rest of the members on the FOMC, the Federal Open Market Committee, are thinking and approaching March. Let's also just take a brief look here at what we're watching here. Well, in the Nasdaq Composite, we'll just ride out with the view as the Nasdaq 100, the tech heavy average. Julie, I'll toss things on over to you.
Thank you so much, Brad. And let's talk more about the markets from the fixed income side of things. Let's get back to Yahoo Finance's executive editor, Brian Sozzi, with exclusive coverage of Double Line Capital's Investor Day. Soz?
Hey, thanks, Julie. Joining me now is Monica Erickson, Double Line investment grade corporate credit manager. Monica, good to see you as always. Thanks for spending some time with us. Top of mind, I imagine, with you and your team right now is interest rate risk, how far rates might go. What is that doing to how you think about your products and what you run?
Yeah, well, I mean, that's where the volatility has been. The volatility has not been in spread product. It's been in the Treasury market. That is what contributed to about 90% of the negative returns last year, which was, as you all know, one of the worst years in over 100 years for the investment grade market. And I would anticipate that the volatility is going to continue to be in the Treasury market, and less so in terms of where credit spreads are going. And you and I talked about this last year in January, and
a year ago.
I know,
I
it's
can't
crazy,
believe it.
right? And
Yeah.
so what we were talking about then was just the duration of the asset class. The duration of the asset class then was at all-time highs, and we were very concerned about, and duration really is the sensitivity to movement in interest rates. And we were very concerned about the asset class then because of its long duration. Going into this year, it's a little bit better set up. Yields across the board, all fixed income are much higher. You're getting close to a 6% yield in the investment grade market, which is at decade highs. And the duration has come down. So the setup is better, but I'm still watching the volatility in the Treasury market.
Given all the concern about where rates are and where they might head, have you been surprised by the flows into corporate bonds?
Not necessarily. I think flows tend to follow returns, and we started this year in January with pretty strong returns. The market was up about 4%. The last couple of weeks have been a little bit more challenging just because of the move in the Treasury market. But no, I think that's just a natural progression of kind of what happens when you see positive returns in an asset class.
I talked to Jeffrey Sherman, Deputy CIO, earlier on. He was talking about the potential for a mild recession. If that does come to fruition, whether it's later this year, early in 2024, how does it impact what you cover?
Well, one of the things, there's several things that we look at, right? And fundamentals really, and that I think that goes to that point of like where are the fundamentals going? The fundamentals, and this is something we talked about last year as well, are fairly strong in the investment grade market. You look at kind of where leverage is. Leverage has come down from the peak. We're at like, call it 3 times kind of cash flow to debt. Interest coverage is pretty high. We're close to all-time highs where companies have about 15 times the amount of cash flow each year to cover their interest expense. And so watching earnings, I think, and that flows back into kind of where the economy is going, is really critical to see where those metrics might fall out. And for the fourth quarter, which we're almost done with earnings, really
good.
Yeah,
good, Monica.
Right.
Earnings season, these seasons just they keep going. They don't end.
Right. Well, and you know, it was an interesting quarter because the weakness was really in the large banks and in tech and large tech like Apple, Meta, those types of companies. So it was really much more of an equity story and less so of a credit story because the banks' balance sheets super solid. The tech companies, the large tech companies, have more cash on their balance sheet than they do have debt. They generate enough cash flow to pay off all of their debt. They've just raised debt over the last 10 years because it's been opportunistic and cheap financing. So this weakness in earnings in the fourth quarter really is much more of an equity story, less of a credit story. Now going forward, we're definitely watching to see what areas, what sectors are going to be weak in this year in 2023. And so far, kind of if you look at consensus estimates, it's really in the energy sector and in materials. Energy is coming off an incredibly strong year last year. And it tends to be a pretty small part of the investment grade market. So the bottom line is, I think the energy or the earnings picture looks pretty benign for investment grade credit just because energy is such a small part of the market. And it's really related to tough comps. balance sheets are still strong.
Let's lock in on the tech sector. Investors awoke today to an icon of America, Intel, cutting its dividend.
Right.
A lot of investors, I'm sure, can't even believe this is happening. But as you zoom out into the broader tech sector, are there more Intels around? How confident are you in these tech fundamentals?
Yeah, well, Intel is an interesting story because they have very specific issues going on with their business. They've been losing market share to their competitors. And I think cutting their dividend is an indication, and I think it's kind of across the board where companies really are focused on their balance sheets, right? So Intel is one of those companies where, and we've been looking at it, right? I think that their fundamentals, they've had a difficult time kind of turning that around, but they are focused on their balance sheet and making sure that it's solid enough that they can come to market when they need to raise capital. And like I said, with the other tech companies that had really bad earnings in the fourth quarter, these are companies like Apple that have more cash than they have debt on their balance sheet. And so it's really, that part of it is much more of an equity story.
So is that where you're finding opportunity? Just stay in cash-rich companies with good fundamentals. Maybe it is an Apple.
Yeah, absolutely. It's kind of going up quality across the board, right? And I think that is what we're doing here at DoubleLine, is that we're really looking for credits, companies that can withstand some volatility in the economy. I mean, I think there's a much higher probability that we go into a slower period, if not a recession. I mean, so far it looks kind of balanced, but I think at some point we will get there. And so I think it is the right time to go up in quality and find companies that have solid businesses, solid fundamentals that can withstand some weakness on the macro level and that have the balance sheets to withstand it as well.
We're starting to see a lot of interest on the Yahoo Finance platform, Monica, on the debt ceiling, how that might impact stocks, how that might impact bonds. As that event approaches, do you see that as destabilizing to the bond market?
Not necessarily for our market. I think that is probably a short-term situation, and I think eventually it does get worked out. I think the biggest risk in our market remains the volatility in yields in the Treasury market. And I think that's going to be driven much more by inflation, the ability of the Fed to control inflation, and where the Fed goes with their interest rates.
So the Fed, the biggest risk to markets this year?
That's my opinion. I think it's the balance of if they can get inflation under control, I think the market will back off in terms of volatility in the Treasury market. If they can't, that's going to be a continuing issue that we're going to have to face. All
right, we'll leave it there. Monica Erickson, DoubleLine investment grade corporate credit manager. Hopefully we can speak before 2024.
That'd be great. I'd love it.
I appreciate it, Monica. Thanks so much. Julie,
Thanks,
back to you.
Brian.
You got a lot of time before 2024 to speak with Monica.
A lot of time.
Thankfully. Saz, we'll talk to you in a little bit, much sooner than that. Another story we have to turn to right now, though, the lawsuit to invalidate Elon Musk's 2018 compensation package awarded by Tesla's board of directors. It's moved a step closer to conclusion. We have Yahoo Finance's Pras Subramanian here with the details. So, Pras, what's going on? What's the latest in this case?
So there was a kind of a, not necessarily hearing, but there was the two sides, the attorneys sort of kind of having a little bit of a last argument there with the judge who's presiding. It's not a jury trial. Basically, they argued for about 3 hours. The judge asked for more written material, so meaning that there could be another few months before we have a decision. But basically, the crux of the case is that the plaintiffs argued that the board didn't give shareholders enough information about the pay package, which eventually became around $70 billion worth of stock, right? So not insignificant there. This pay package was to keep Musk more motivated to do work at Tesla, but he went out and he's co-CEO of SpaceX, and then he eventually bought Twitter at some point. So there's that there, and then the problem with board management, right, is the board is handpicked by Musk, as they're alleging, and can they actually have oversight and actually manage Musk? And the plaintiffs say no, they can't. The defense obviously is arguing against that case. So it basically comes down to what the judge believes is true, and it seems that there's indication from the New York Times that the question the judge was posing to plaintiff's counsel seemed to be that he was maybe leaning in favor of ruling in their favor. But the question is damages. It's going to be a hard argument because Tesla stock went up during the whole time, so you can't allege that the shareholders suffered any damage. The stock went up like 100%. So it's sort of like even if they win, they may not win that much.
Sure. Okay. So even if they did win, would Musk have to forfeit already earned or already received pay in this? What would be kind of the proceedings to actually make those investors whole to whatever extent they deem that to be necessary?
I don't think I'm not an expert when it comes to these types of damage situations, but my belief is that they won't claw it back from Musk. It'll be a settlement that the actual company will have to pay shareholders out in some fashion, and lawyers will of course get a cut of that, but it won't actually be coming out of Musk's its wallet as far as I know.
All right, Pras, thanks so much. Very interesting case.
Not a lawyer. Don't take any advice from me.
But the lawyers are like the house, and the house always wins. So.
Yeah, that's true. They win no matter who wins. Right. It's true. It's true. All right, Pras, and you're going to be back with us in a little bit for an interview too, so we'll see you soon. Coming up next, though, one of the companies that is frequently cited as benefiting from the growth of AI reports after the close of trade. And we're talking about NVIDIA, and Dan Halley's going to join us for a preview next.
Check it out, everyone. After the call, coming at you. And guess what? The next company that we're going to be listening close to is NVIDIA. Julie, what are you going to be watching for?
I mean, they already are one of the original AI companies. You know they're going to talk about that buzzword somewhere along the way.
I'm going to be watching for those graphics processing units, the GPUs. Ladies and gents, boys and girls, tune in to After the Call. We break down all things NVIDIA. There aren't many tech companies with the size and scope of NVIDIA. Its graphics processors are used by some of the world's biggest companies, not to mention gamers and crypto miners the world over. It's now well positioned to benefit from the growing AI boom. And we're all going to be all over today's call. 5 p.m. Eastern time. Joining us for After the Call this evening, the one and only Dan Halley. Dan, what are you going to be watching for?
Basically, everything you just said. I mean, look, it's a company with two main businesses at this point. They're trying to expand further into automotive, into robotics, professional visual computing, but really it's about that data center. It's about the gaming. And I think, we're going to once again see a disappointing quarter as far as the gaming side of things goes. It's tough to really call it, a complete negative for NVIDIA in that sense, though. Last quarter, we saw a 51% decline year over year in gaming revenue. And the reason for that is the same thing we've been saying about Intel and other chip makers, as well as game companies, that people went out, they bought their systems to run games, and now they don't necessarily need to upgrade right away. And I think that's something that we're going to continue to see. However, if you take out the pandemic era and you go from Q4 2019, which for whatever reason, NVIDIA decides to call 2020, their fiscal calendar is just all sorts of out of whack. Don't even try to figure it out. The gaming revenue then was $1.5 billion. And what we're expecting in this quarter is $1.6 billion. So it's still up from pre-pandemic slightly, but it's not, it's not going to touch that enormous boost that we saw during the pandemic. Now, on the flip side, revenue is expected to rise year over year from to decline from 7.64 billion to 6 billion, but the data center revenue is expected to rise, and that, I think, is where the most important action is. That's where the company really has seen, the majority of investors lean in. They're not looking at games. Some are. The majority, though, are looking at the AI side of things. And so they've seen that revenue just go absolutely bonkers from $954 million in Q4 2019 to what's expected to be $3.87 billion this quarter. So, it's a huge jump for them. The Chat GPT stuff, the Bing stuff, the Google Bard stuff, that's all just kind of fuel for the fire.
That's all data
for
center.
AI.
That's sort of in data center because the AI needs to learn.
Exactly.
That's what makes it do what it does. So it needs all that data
and it
processing.
can't use regular CPUs from Intel or anything like that. It needs GPUs because they're so good at handling such massive amounts of processing.
Yeah, definitely. And then we'll be watching the auto revenue, for example, as well, even though it's a lot smaller than the other areas. And we're going to be continuing to talk about all of this. Don't forget to tune into the latest edition of After the Call. It'll be my maiden voyage, and that's happening at around 6 p.m. Eastern time when the NVIDIA call wraps. But Dan, while we have you here, there's another story that we are watching, and it has to do with Meta. The Washington Post is just out with a story saying that Meta is going to be announcing yet more job cuts after it already cut substantially. What have you been hearing in terms of chatter about what Meta's going to need to do on this front?
Yeah, people inside have already been kind of aware of this. Their ears are on, perked up. They're on alert as to whether or not they're, going to be losing their jobs or they're going to be able to hold on to them. And this, is part of this year of efficiency that Mark Zuckerberg had laid out during Meta's latest earnings call. It's all about kind of making the company leaner and ensuring that, look, while they continue to invest in the metaverse, something that investors are for sure wary about, they want to ensure that they're also cutting back on some areas where they may have overexpanded during the pandemic. And look, we've talked about this before. This is basically these companies' own doing, where they all expanded thinking that we were going to turn into, I said this before, the people from WALL-E and just hang out in our chairs forever. And they were like, well, we'll hire for that world because that's what's going to happen. It turns out we like to go outside still. And so, they
we like to use our legs.
Yeah. So it turns out they overexpanded. They now they're kind of course correcting for their own mistakes. And, I guess you could say to their credit, a lot of the CEOs for some of the big tech firms have come out and said, look, we thought that this was going to be the future, and it's not. And, now they're dealing with it. They're still getting fat paychecks, but the workers who are getting laid off, they're the ones that actually have to deal with it.
Right, and asking, you did all this spending on this area that's not going to pay off, at least in the next 2 to 3 and maybe even 5 to 10 years. So now it's this larger question of what the flattening of their org structure continues to look like, because they allocated capital and mismanaged that allocation of capital. I think it's fair to say at this point in time. They said this and acknowledged it in their most recent earnings call that you had alluded to as well. They're removing some layers of middle management, trying to make decisions faster, deploying AI tools to help their engineers be more productive. So how quickly could this shift take place, and how much different of a Meta platforms could we be looking at the end of the day?
I mean, there were some analysts who were, really hyped on the fact that they're cutting back on some spending. I think when they looked at the last earnings call, it wasn't, the last earnings report, it wasn't as bad as maybe they expected. But it sounded like they were, to me at least, maybe overly enthusiastic about where the ad market is at this point. Because, you looked at Google, they were down. You looked at Meta, they were down. You looked at Snap, they're just, in this morass that they're trying to pull themselves out of. But, there's also, on the flip side of that, there's, the stronger dollar. So that's, impacting their earnings as well. I think, when it comes to something like a Meta, It appears as though they may have gotten around the issue of the Apple privacy changes that really slammed them hard for the past year. Now it's just the digital ad market and whether or not that's coming back stronger. You know, I think it's something where, again, this is a company that's pushing billions of dollars of resources into a platform that, I mean, frankly, may never really take off. This vision of the metaverse with these headsets. You know, sure, Apple's coming out with something, but the vision of the metaverse as Meta has it, where you're in a headset, eventually you're wearing glasses. You know, I mean, we have...
Glasses haven't done well. Google Glass, not great. Spectacles, not great.
Right.
So now you're looking at an Oculus that, sure, for some gaming has been decent.
Right.
And elevated the gameplay experience in that facet for which game players decide whether or not they want to be in virtual reality. But for an everyday usage to the point where Julie and I want to...
We're not there yet.
Want to have your meeting?
Have our meeting?
Yeah, no.
I don't think so. All right, we got to leave it there. Dan, we will catch up with you later, but thank you so much for talking with us about all of this stuff. Coming up, more money, fewer problems. Sean Diddy Combs is expanding his business portfolio. We're going to speak with the president of Combs Global next.
Sean Diddy Combs expanding his enterprise, rebranding his company to Combs Global, and expanding his business portfolio as the company makes plans to go more international. Combs Global President Tarek Brooks joins us now. Great to have you here with us this morning, and thanks so much for taking the time. Talk to us a little bit about this expansion and what some of the first areas that you're really prioritizing within this expansion more globally will entail.
Good morning. Thank you so much for having me. The transition to Combs Global is really a reflection and a reminder of who Combs Global is and who our founder is. Sean Combs has been a global celebrity for many years. Our brands from Ciroc to Sean John have all been global brands that have helped to drive culture. And so the change of the name is really a reflection of who we are and a reminder of one of the key values that Sean Combs instills throughout the organization, which is to dream big. So when we think about everything we do, we think about the ability to have a really global impact. So we're excited to continue to expand our portfolio. It already includes 2 spirits brands, Ciroc Vodka and De Leon Tequila, a global TV and digital media platform in Revolt, 2 record labels, Bad Boy Records and Love Records, and our first new artist, Jazzy, on Love Records, will release her first EP on Friday. Super excited about that. And the platform goes on and on. So we're super excited to continue to build and grow. And even as recently as November, we announced the potential acquisition of cannabis assets to bring us into that space as well. So growing in a number of different directions that we're really excited about.
Yeah, Tarek, it's Julie here. I mean, this is a really diverse portfolio of different kinds of businesses, right? As you were just talking about, you got some record labels in there, you have alcohol brands, you're going to have a cannabis brand, there's a charter school business as well. How do you think about them as one business, and how do you think about opportunities for synergies between them, et cetera?
Yeah, and before I answer that, it's actually a charter school network, 3 schools serving over 4,000 students every day across 2 different states, Connecticut and New York. But the ecosystem that you're referring to is one where we develop a competitive advantage to be able to find synergies and opportunity to glean data and insights that other folks that we compete with just don't have, because we're able to leverage the insights that come from businesses that are seemingly disconnected to help create broader pictures of the consumers we serve. And in that case, we like to say, we don't play fair, because we learn, from our media business about our tequila customers. We learn from our Ciroc business about our potential fashion customers, and so on and so forth. And so we think that gives us a meaningful insight in all the spaces we compete.
I think it's been amazing, especially over the course of my lifetime, being able to watch Sean Combs, the man who has been absolute wrecking ball across music and entertainment, been able to diversify investments in himself as well, and starting fashion, clothing lines, and going even more into other ventures. So when you think about, because I remember wearing the Sean John clothes growing up, when you think about now looking at other ventures out there and deciding how to invest in founders and in businesses that may be recession proof, what do you look for?
Yeah. Well, listen, part of what we look for is the same as any other, VC or private equity shop. We look for an amazingly strong founding team. We also look for ideas that are disruptive, that have protective moats, and have the ability to grow very fast. The layer we add on to that is we look for opportunities to leverage those same investments with our current portfolio companies. So as we go through our process of evaluating the company, we think about whether or not there are applications that exist in our current platform, so that we can be a kind of use case as well as an investor as the business grows and develops.
And I know in your own personal background as well, you had worked with Bridgewater in the past. Of course, many of our viewers know that, and next Ray Dalio to that in the past as well. Given that kind of investment history that you have, and the venture capital arm, one thing for Combs Global, but then additionally, do you look at the equity markets all and say, you know what, there's opportunity to have our own Combs Global portfolio of equity market investments, considering where the markets are at right now?
Yeah, I mean, it's interesting. Look, we look at all possible investment opportunities, but one of the things we always think about is where do we believe we can generate outsized returns, and where are those highest returns to be found? And for us, when we think about the developmental opportunities within our own platform, we feel very confident about our ability to generate meaningful returns, continuing to build and grow that platform. And so while we'll always look at any investment that can make sense broadly, we think about what we could do with capital in our ecosystem, exploiting the synergies we have, growing and developing the new markets that we see as potential. For as big and as broad as our portfolio is, there's still a ton of great growth opportunities, including taking De Leon Tequila international, launching the e-commerce platform that we're developing with Salesforce to help revolutionize the way Black businesses participate in e-commerce, and so on and so forth. I mean, they're just great ideas that we feel like we are uniquely suited to exploit, that, beyond being impactful to society, will generate, great returns for us as well as our investors.
And Tarek, finally, again, going back to this portfolio that you guys have, you also get a lot of intel on what's going on out there in the economy through a lot of different avenues. So what are you seeing? Do you see signs of recession? How is consumption of your brands? Tell us what's going on.
What was interesting when we talk to our partners and our advertisers, we definitely hear concern, and we are worried, just like everyone else, about the softness in the advertising market, which drives several of our businesses. But one of the things that we're acutely aware of is that advertisers in the post-George Floyd era made commitments, as well as investors made commitments to the African American community. And what we don't want to allow to happen is to have those advertisers, those investors, take this opportunity where there's some softness in the economy to backpedal on those commitments. So we're going to hold folks accountable to delivering the investments and the advertising dollars that they said they would, despite the fact that there is some softness in the economy.
That is a great reminder for a lot of folks who maybe it's dropped off the radar, and it shouldn't have. Combs Global President Tarek Brooks, thank you so much. Appreciate it.
Thank you very much for having me.
Coming up, we'll go back to Florida, where Saz is going to have another exclusive interview over DoubleLine Capital. Keep it right here.
Welcome back to Yahoo Finance. I'm Brian Sozzi, still in Tampa at DoubleLine's Key Investor Day. And joining me now is Luz Padilla, DoubleLine International Fixed Income Director. Luz, good to see you here this morning. Thanks for joining us. The thread that is tying all of our interviews together today with the DoubleLine team is interest rate risk, lots of fear and concern about what the Fed may or may not do on rates. From an emerging market perspective, how do higher rates impact what you're doing?
Well, they obviously increase the cost of funding for our countries and our companies. But it's been interesting to see the rise, especially these last couple years, I would say. And now we're at a point where all-in yields for emerging market debt are around 8.5%. I think 9% is an interesting level if people are thinking of getting into an asset class that I think is an improving credit story. So to me, when you look at all these countries, all their potential with their natural resources, their population, they have a lot to work with, and they've done a good job. As I was telling you earlier, this asset class came from basically almost being unrated to now 50% of our countries are investment grade rated. I think we can, do better, and in fact, we have done better. So I think that will continue, mostly because people want a better life, whether they're in the U.S. or they're in Brazil, and I think they'll demand that from their policymakers.
If rates in the U.S. do touch close to 6%, if the Fed pushes that far to fight inflation, what type of ripple effects will happen in emerging markets?
Well, I think certainly that could happen, and it's something that everybody's sort of concerned about. It'll depend on what happens with growth. I think right now, people are talking about a no landing scenario, which means no recession, and so I think that could be an interesting situation for emerging markets, because emerging markets have been growing at almost multiples of what developed market rates are doing, and so if we don't see a recession, that means that all these countries, all these companies can continue to do well. And so I think that could offset, that increase in yield, because we may see spread tightening on the other end.
What's the best position emerging market from your vantage point?
Well, and this could be, again, a bias. I like Mexico. Mexico, seems to be ready to be able to take advantage of, the what they call now nearshoring of your products. And so instead of going to China, you may see more people open up more factories in Mexico. I think they also have natural resources. They have a good population, and so I expect that they will continue to migrate up, their credit curve.
Are you putting a lot of money to work in China on the view that the economy will rapidly improve as it continues to reopen later this year?
We actually did the opposite, and the reason for that is mostly to do with Russia, and the after effects of the Russian invasion on Ukraine in our markets were, even for me, I think, having been in this particular asset class since '94, were shocking. Basically, Russia was almost immediately taken out of our index. They went from an investment grade story to a non-rated credit. Then people couldn't even invest in Russian credits. And so, they went from trading 200 over to 1,000 plus in almost the blink of an eye. And, had nothing to do with their fundamentals and everything to do with their, maybe nation building, if you want to call it that. And not that we would expect the same the same treatment for China, but the Chinese credits that we look at are investment grade rated. They're not yielding a lot, and so for me to have that one thing out there, that could basically blow up your whole investment case, that may or may not come true, but where you're not really getting paid all that much. And how do you even price that? If China invades Taiwan, then what happens to the Chinese credits? So to me, I'd rather not participate at this point.
So you're not positioned as if there is an invasion. You're not there yet.
I'm not there. I don't think. I hope, like everybody else does, that it doesn't happen. I think. But or maybe not the Chinese, maybe they do want, but most everybody in the world. But I do think that there is a low level risk that could increase the spreads of those credits. And so again, at this point, there are much more interesting opportunities elsewhere without that particular risk.
We're coming up on the 1 year mark of the Russia-Ukraine war. Why, from a stock standpoint, why is that event fallen in the background, in the minds of investors? And then what does it mean to emerging market debt? Because clearly this war is continuing.
It is, yeah. Investors have short memories. It's sad to say, and unless it's, ever present and you're getting beat over the head, people can just let that go. I think, for us, we have to care because it will impact, let's say, the region. And so for me, I look at that whole region, and again, it's difficult to put money to work there. In terms of like the equity markets, you have your own issues. So for me, I look at, U.S. companies and maybe European is more closely attached, but Asian companies, and they're like, okay, we've got our own stuff to deal with. Whatever's happening there, it seems to be muddling along. And as long as that continues, we're okay. As long as there's no increased escalation, it could happen.
And when you model out different scenarios, when you're putting money to work, is the Russia-Ukraine war still a key risk you think about, and how high up the pole is it?
It is still a risk because an escalation could occur, and then then we're talking about a sort of more global problem. I think right now, let's say the base case is that the U.S., Europeans continue to support Ukraine. This thing will kind of continue to muddle along until both leaders decide, okay, where is the off ramp? Is it new leadership in Russia? Maybe, but it's really hard to see that right now.
You're also have an interesting snapshot into India, looking through the prism of Adani and just the ripple effects, that situation, of course, that short seller report against Adani. What has been the appetite for India's debt given that situation?
Well, certainly for the Adani debt, it's been sort of, almost a tale of two types of investors. Distressed investors have come in and snapped up some of those bonds. And then what we call real money investors, or maybe crossover investors, i.e. investors that invest in investment grade credits that will go into, EM companies. They couldn't find the doors fast enough. And so you've seen, the moves in prices. For us, as I was telling you, it's time to retest our assumptions, relook at what we thought we knew. Is it still true? Adani has always had, let's say, a checkered past. So that's something that if you didn't know that going in, you probably hadn't done a lot of research on it. And it's interesting because we've been talking to some local analysts, and that's basically some of the same commentary that yes, there always has been, let's say some concern regarding the transparency of that company. But when you look at the hard assets that they have, the products and services that they generate, they seem to provide a real value proposition.
Super helpful insight. Luz Padilla, Double Line International Fixed Income Director. Good to finally speak with you. We appreciate it.
Thank you so much.
All right, much more ahead on all things markets on Yahoo Finance. We'll be right back.
Shares of Driven Brands are in focus this morning after reporting record revenue in 2022, driven by a 14% boost to same-store sales and 9% net store growth. Driven Brands CEO Jonathan Fitzpatrick joins us now alongside Yahoo Finance's Pras Subramanian. Great to have you here with us today. Walk us through some of the catalysts that you saw last year. Does that continue to be a tailwind that you could ride here into 2023?
Yeah, thanks for having me on. Yeah, we're super pleased with the results last year. Great effort from the entire 11,000 team members at Driven Brands, our amazing franchisees, and our long and loyal customers. 2022 was a sort of challenging year on many fronts. We're super pleased with the results. We grew revenue 39%, same-store sales 14%, and adjusted EBITDA 42%. So we also gave guidance for 2023, and I would say we gave guidance above consensus this morning and are feeling pretty positive around the momentum heading into sort of Q1 and the balance of 2023.
Hey, Jonathan Pross here. So a lot of people don't know, Driven Brands, you guys run Meineke mufflers, Mako kind of paint and auto body repair stuff, but also you guys are getting into the kind of quick service oil change business, and that's been doing really well for you. How is that offering different than what people kind of see when they kind of go downtown to their regular oil place or a Jiffy Lube, for instance?
Yeah, hi, Praz. Good morning. Good to see you. We have this phenomenal brand called Take 5 Quick Lube. It is a differentiated service model, which is a drive-through, stay in your car, 10-minute oil change with a very limited set of menu offerings, which enables us to deliver that 10 minutes or less speed of service. We mentioned in our earnings release this morning that business in Q4 delivered 25% same-store sales. It's now got about 850 locations in North America. We grew unit count by about 20% last year and expect to grow unit count another 20% this year, primarily with franchise locations. So an unbelievable business model that is super convenient, fast, and friendly for our consumers. And then, we're also rebranding our car wash business. We have 400 car wash locations. We're leveraging the success with the Take 5 Quick Lube business, rebranding all of those stores to Take 5 Car Wash. So as you look ahead to the end of 2023, we'll have about 1,400 locations in North America, all trading under the Take 5 brand umbrella. So super excited about both the Quick Lube and the car wash rebranding that's underway at the moment.
Jonathan, it's Julie here. Across all of your brands, and you mentioned 2022 was a challenging year, it's also been challenging for car sales, right? In part because of what we've seen on the pricing and availability front. What are you seeing at your locations and your franchisees' locations in terms of people sort of driving beaters into the ground, right? Just maintaining their older cars to keep them going?
Yeah, Julie, great question. And I think it's important for people to understand that the average age of the vehicle has crossed 12 years. It did so last year, but that age of the vehicle has been expanding over the last decade. And why is that happening? It's because cars are made better 10, 15 years ago than they were 30 and 40 years ago. So cars last longer. When you look at sort of the macro backdrop in 2022, and certainly I think in 2023, the cost and availability of new cars and the cost of, used cars is at an all-time high. Prices have gone up 30, 40% since pre-pandemic levels. Our core customer has a household income of about $70,000. So our core customer have older cars and will be sort of, forced, if you like, to hold on to those cars for longer. That then provides sort of auto service tailwinds to our business as customers hold on to their cars longer and the cost of repair and maintenance increases with higher mileage, older vehicles.
Hey, Jonathan, as you kind of look further ahead, kind of beyond, the kind of the transition to EVs, let's say, your guys' business, how do you kind of leverage that in terms of these cars, EVs don't need that much servicing, but they still need some servicing. So how do you sort of capitalize on that as we see more and more EVs on the road?
Yeah, it's a great question. And I think, look, the EV adoption in the United States is happening. I think it's happening at a slightly slower pace than people sort of anticipated, 5, 6, 7 years ago. As a percentage of the overall car park, we've got 280 million vehicles on the road today, with about less than 5% being fully electric vehicles. That being said, we're very conscious of the opportunity with EV as we look into the next decade. Two things that we did over the last couple of years, we got into the car wash space, and obviously we wash all types of cars in our car wash business. And then last year, we entered into the auto glass replacement business, which again is ambivalent to what type of vehicle it has. So we're excited about the transition to EV. I think it's probably going to take a little bit longer than people think. And then strategically, we're leaning into the opportunity with obviously glass and car wash, as I just mentioned.
It sounds like a pretty significant structural shift, though, especially for the parts of the vehicle that you've grown accustomed to servicing over years. Where does that also mean further restructuring of not just the amount of franchisees that you work with, the types of products that you then take on as inventory, and over what time span are you kind of looking out into the future to already get ahead of some of these potential changes?
Yeah, Brad, I mean, we've sort of modeled what EV adoption looks like and taken all sort of inputs from lots of smart people who've looked at this. We don't think there's a tipping point in terms of EV getting to a majority of the car park until the late 2030s. So if you look at our quick lube business, for example, we've got at least 10 more years of significant growth, both revenue, unit count, and bottom line. And then we have a team right now that's evaluating what are incremental EV-related services that we would want to implement in that quick lube business. So is it, charging? Is it battery replacement? Is there other, parts of the automobile that will be needed to be serviced? So, we're playing the long ball here. We do think there's at least 10 to 15 years before we reach that tipping point, and obviously we'll be well prepared to adopt and evolve, as needed, as the car park slowly changes.
I mean, again, it is a very small percentage of the total now, but I am curious of what you've seen so far among EVs, like what breaks the most, or what do people come in for the most if they have EVs?
Yeah, so the EVs, Julie, that we'd be servicing right now would be in our car wash space. So we're not sort of fixing there. We're cleaning and making cars look better. Certainly in our collision business, we do multiple $1 billion of insurance-based collision repair within that space. We obviously fix lots of EV vehicles. So those are the two places. And then within our glass segment as well. So we don't really have a view on what's working or not working in the vehicles based on the segments that we operate in today.
Well, you certainly brought some nostalgia to our morning meeting today when we were talking about the AA Hong Kong MCO. Thanks so much, Jonathan Fitzpatrick, Driven Brands CEO, along with Yahoo Finance's Pras Subramanian. Thanks a lot. Appreciate it, Jonathan.
Take care. Bye-bye.
Thank you. Well, coming up, Rochelle Kuvo is going to get a pulse check on the travel industry in an exclusive interview with Wyndham Hotels and Resorts CFO. Folks should stay tuned for that.
They should, absolutely. And we've got some motorcycles in studio. You're going to want to watch that as well, folks. The 11 a.m. starting in just a few minutes.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks trying to claw back ground after the worst day of 2023, but rate fears keep a lid on enthusiasm. We'll keep an eye on those all-important Fed minutes, and we'll tell you why they matter. And future vaccinology. Moderna made $18 billion in COVID-19 vaccine sales last year, but its focus is increasingly on growth beyond the pandemic. We'll discuss the future for mRNA with its founder. And going full throttle after a big 2022, is motorcycle maker Ducati still riding the highs? We'll talk demand, supply chain hiccups, and consumer belt tightening with its North America CEO. But first, let's take a look at where the major indices stand this morning. A turnaround tale here from what we saw at the open here. They've all turned to positive territory, although only just. We see the Dow there up about 24 points, just up there fractionally. The S&P 500 up about 2 points on the day. The Nasdaq up about 17 points. We're seeing obviously some of this rally that we saw. Some taking a bit of measure here, a bit of a deep breath before we get those FOMC meeting minutes. Let's also take a look on the Treasury market as well, because we had been seeing a divergence between the direction of bond yields and what we've been seeing with stocks. And so we'll see how that shifts as well when we get more detail on how close the Fed was on deciding from a 25 basis point to a 50 basis point hike. As you can see there, pullbacks there in all three of the short and longer term yields. Right, well, first, a look at the top issue moving markets. The Fed set to release its latest minutes, an important signal to the markets for where the Fed is steering the economy. Here with more, Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, that's right. And those Fed minutes are really a glimpse into what the Fed members were talking about, discussing, where their frame of mind was at the time during that FOMC meeting that took place between January 31st and February 1st. After that meeting, the Fed announced that it was going to be raising interest rates by 25 basis points. These are backward-looking minutes at that meeting. But it's important because after that meeting, we had more economic data that came out. We had a hotter than expected CPI print. We also had a tighter than expected labor market for January, even though you had those seasonal adjustments. And more importantly, we had two Fed members who are non-voting members who said that they saw a case for a 50 basis point rate hike. And that is what recently has spooked the markets, because what will these Fed minutes show us? Are other members of the FOMC, the voting members, thinking about perhaps a 50 basis point rate hike? Could they possibly do that at the next meeting? Right now, the market is forecasting that perhaps the Fed will raise interest rates by 25 basis points each time for the next three meetings. But if the next one is 50 basis points, then that would certainly be something different for the market. And that's why we saw a little bit of downward pressure on the market over the last several sessions. And in fact, we could see even more pressure depending on what comes out of those meetings, so of those minutes. So they're very important in this case. Now, we do have PCE, that's the inflation read on the producer side, that is the preferred metric that the Fed is going to also be looking at before the next meeting that they have in March. So a lot to pay attention to when those minutes do come out this afternoon, Rochelle.
And speaking of things to pay attention to, what about energy prices? How are they moving this morning?
Yeah, right now we have energy prices that are lower. We're looking at Brent crude that's down about 2%. I'm pulling up my Wi-Fi interactive board right here. We also are looking at WTI that's down about 2%. By the way, those Fed minutes could give a glimpse of the next policy move. So you could see higher interest rates because of that, of course, with that policy move. And so if that happens, then the market could be anticipating that the dollar would go higher. When the dollar goes higher, we do see assets that are denominated in US dollars go lower. But some of this move that we have been seeing recently when it comes to these oil prices are growing recessionary concerns. You do have US inventories, which recently came in higher than expected. You also have had some firms recently that have been pulling down their estimates for where they see oil in the second half of the year. Morgan Stanley cutting its forecast for the second half of the year for Brent, saying that now it could reach $90 to $100 a barrel. Before it was $100 to $110 a barrel. JP Morgan, Bank of America, also perhaps seeing that oil prices this year may not go as far as they had anticipated. So when it comes to oil, you really have to think about several factors: where the US dollar is, expectations for a slowdown, a global economic slowdown, of course, Russia export cuts and the impacts that they could have, and also the China reopening, because we know that the China reopening and recovery has been bullish for oil prices. But if you have an economic slowdown, recession in different parts of the world, then that definitely will impact demand, regardless of what happens also in China.
We'll certainly be keeping an eye on that, Ines Frey. Thank you for that update there. Right, well, our coverage of a critical story shaking up tech continues. The Supreme Court hearing arguments against a law that protects how content is hosted and moderated online. Now, the ongoing fight concerns Section 230 of the Communications Decency Act. Now, that protects everything from TikTok to review sites from being sued over what third-party users post. Here now with how companies might be affected, Yahoo Finance's Alexis Keenan. Hey, Alexis.
Hey there. So yeah, the Supreme Court is hearing two different cases. One was yesterday. I was there for oral arguments at the Supreme Court yesterday, and that was a case against YouTube and Google. Today, the court is hearing a mirror image case on this Section 230 law against Twitter, Google, as well as Facebook. Now, what this law does is what you were mentioning there is it protects content hosts, these online websites, owners of websites, from being liable for what other people say. So the posts, the impressions, the shares, the videos that other people upload to these sites, this law has since 1996 protected them from not having liability over those comments. Now, the suit from yesterday as well as today, both of those cases, they arise from terrorist attacks, from ISIS terrorist attacks, one in 2015 and one in 2017, where the plaintiffs are the estates of the deceased victims of these attacks, and they argue that the companies should be held liable and that Section 230 should not apply because they took affirmative actions to support terrorism. That is sort of the crux of the argument. There are some technical difficulties between the cases, though in the first case, the plaintiffs say that YouTube should lose its immunity because its algorithms recommended harmful third-party content, that is those ISIS videos that ISIS sympathizers then presumably watch. In the second case, it's more about, and Twitter is up there on in the Supreme Court right now as we speak, arguing its case. The plaintiffs there say that Twitter, Facebook, Google, and others should be held accountable and have no protection under Section 230 when they fail to block harmful content. Now, let's talk about the stakes for both major media companies, major social media companies, as well as just plain old independent, smaller site owners. This impacts all of those parties that would host third-party content. But let's look at annual revenues for advertising in 2022. First, take a look at Google, $224.5 billion earned last year on advertising alone. And what you have to think about here is that if Section 230 changes and its scope is limited to put more liability on these companies for what other people say, that then their advertising revenues would presumably take a significant hit. Look at Facebook, $113.6 billion in advertising revenue last year. And if we look at Twitter's second quarter, we don't have full annual results after the Musk acquisition of the company and now that it's private. But in that quarter of 2022, about $1.18 billion in revenue there. So, Rochelle, these cases are just major cases. The justices, though, struggling with trying to figure out how, if at all, they would change this law because it's really difficult to figure out what is just an algorithm acting operating sort of in a, if you can even say there's a neutral capacity for algorithms to operate, because they are created by humans after all, but an algorithm that just kind of applies the same system to no matter who is searching to serve them up content they might want, versus making an actual recommendation to a user to say, based on your profile, you should take a look at this content. So that is what the court is grappling with over these 2 days.
I mean, there could be incredible consequences here. You have to wonder what this means for moderating when people do try and put content online. How quickly, especially if you're a small business, can you really keep up with the content that's coming out at a rapid pace? Yahoo Finance's Alexis Keenan. Thanks. Great stuff there. All right, coming up, we discuss the future for big pharma and biotech with the co-founder and CEO of Moderna. Stay tuned. Now to the future for big pharma and biotech. Moderna generated over $18 billion in COVID-19 vaccine sales last year, but the focus for the group seems to be increasingly on sales beyond the pandemic. A new era in vaccinology looks to be adding to that strategy. Now, the company has announced a collaboration with Life Edit Therapeutics to enable the discovery of new mRNA editing therapies. Its CEO has made this focus no secret. He's already touted plans to have an mRNA facility on every continent to boost pandemic growth. Now, last week, it also reported mixed results in a study into an mRNA flu vaccine candidate. Shares did take a hit on the announcement. Meanwhile, Flagship Pioneering, founded by Moderna's co-founder Noubar Afeyan, has its sights set on a new segment, agriculture. Well, joining us now is Noubar Afeyan, Moderna co-founder and CEO of Flagship Pioneering. He joins us alongside Yahoo Finance's Anjali Kemlani. Thank you for joining us this morning. I do first want to start with Moderna, obviously an incredible game changer with its mRNA technology. Talk about where the company goes from here in terms of advancing on that and investments in that space versus, say, other parts of the business.
Sure. Well, good morning and thanks for having me. Yes, Moderna has pioneered a platform that allows a class of molecules that exist in nature called mRNA to become the future of medicines. And we've shown that in the case of vaccines, but more and more, We're also showing it in many other applications where we can use these to conduct therapeutic, to show therapeutic activity. So we're working actively in cancer, we're working in autoimmune diseases, we're working in rare genetic diseases, and steadily we're generating human clinical data that proves out that this approach is broadly applicable. Of course, we're also continuing to work in vaccines where we have over 20 programs active, and the most recent data that the company put out, one in RSV and another respiratory infectious disease beyond COVID, as well as in personalized cancer vaccines, show some very interesting first of its kind results. We're also working on flu and seasonal flu. So we expect all of this to really create a new future where we have programmable medicines that can be rapidly deployed against any number of unmet medical needs.
Absolutely, and especially building on that technology for therapies themselves, to your point, an interesting area. Nubar, I know that we want to get to your ag portfolio, but just really quickly on Moderna for a second. One of the things really that has really caught the attention is the pricing of the vaccines, first setting the price at over $100 and then saying that it's going to be kept free. Can you walk us through sort of the thought process of why you've landed on and why the company has landed on keeping vaccines free for COVID?
Actually, I think the company has already publicly announced its programs to make sure that anyone who is uninsured has access through our special program. And so this notion that the vaccine will be costly to people who are uninsured, which has been one of the things that have been raised out, is something that we've already addressed. Otherwise, I think you should just follow the company's own announcements having to do with how they think about value, how they think about price. And I think it'll be more and more clear that we're thinking of this as a long-term business.
And definitely something else that is a part of the long-term business is looking at, where it started. There was definitely a lot of government collaboration to get to this point. That's going to be a point of interest in next month when Stefan speaks in front of Congress. Can you give us a little bit of insight into sort of how you're thinking about what will basically be discussed at the Senate testimony next month?
It's no secret that Moderna has enjoyed a very strong collaboration with many, many groups, in addition to the roughly $5 billion of capital that it secured over a decade of platform development and the corporate partnerships that we did with multiple very, very capable pharmaceutical companies. We also had partnerships with government colleagues, whether it was from BARDA or DARPA or the NIH, some scientific, some clinical, some purely financial. And that continued and set us up during COVID to be able to do what I think by any measure is quite an unexpected feat, which is to be able to not only develop and produce and supply a vaccine, but do so in less than a year, and then the next year scale it up to 1 billion doses. The team at Moderna is very proud of that. It's poised to continue to do that in many other disease areas. And we look forward to continuing to collaborate with not only the US government, but every other government out there as we expand our reach, we start constructing plants in different continents, as was mentioned earlier. And I think that we're very aware of our responsibilities to communicate, to explain our strategies, and we look forward to doing that every chance we have.
And Nubar, I know that you focus a lot on human health and sustainability as part of the types of businesses that you tend to approach. So as part of Flagship Pioneering, I know that Inari is a seed design company that comes under this umbrella. Talk about what this company does and how it does it differently from some of these other seed companies that use GMOs.
Absolutely. And so it's interesting in that the field of biology, which is really the study of life, actually offers opportunities to take learnings from one aspect of life, which is to do with health, human health, and apply it to other areas. Sometimes people think about animal health, and in our case, we also think about agricultural health. And so it turns out that the health of plants and what affects them is very, very important in the yield of crops, the various traits that one is looking for. And so we took a health-based approach to looking at seed design, to looking at many other aspects of agriculture. And Inari in particular, the company you mentioned, is really a pioneer in applying technologies that were developed to be applied primarily to human health into agriculture, in this particular case, what's called multiplex gene editing, which is something that we have perfected and shown for the first time, can give us much, much more dramatic improvements in yield, in the kind of traits that one wants through breeding. And we think that this approach not only is applicable to improving agricultural output, but also minimizing the resource utilization, whether it's water, whether it's fertilizers, et cetera. So this is a very exciting development in that by looking at adjacencies of the science we're already doing, we're able to impact the planet in more than just one way, in this case, planetary health instead of human health.
Well, it is also related to human health, isn't it, Nubar? Because I know that in the health industry at large, there's been a lot of discussion about food and the access to it. And I know now you're developing this portfolio of different companies that help with agriculture in some way, including Indigo, Inari, Envio, and SIBO. Tell me about why the interest in these. They do different things in terms of helping farmers create sustainability and move to sustainable farming. At a time that we are right now, what's the concern that you're looking at, or why get into agriculture right now?
Well, you know, the nature of our business is such that, like Moderna, which we founded in 2010, these were companies that were founded in 2013, 15, 16, the ones you just mentioned, and only now are they beginning to appear as potentially impactful to some important global challenges. So the logic is the following. When you look at some of the big unmet needs, challenges on the planet, and the ones that advances and innovations could address, we found that in agriculture, there is some real stresses out there. And of course, it starts from food insecurity. We just, given populations on the planet and the inequity with which people have access to a reliable supply of food, how we do agriculture matters there. The resource depletion that agriculture is causing, all of these things can be taken into account in designing a next generation of technologies. And in our case, these are heavily based on our knowledge of life science and biology. So for example, the company Indigo, which is the oldest company in this space we have, so over 8 years old now, really started out by developing microbial treatments, biological treatments of seed to be able to enhance their traits. So it's a different approach than manipulating the genes of seeds. And through that starting point, we actually started learning about new opportunities, and that is particularly in the carbon space. So when you think about agriculture, you may not think that it has a lot to do with carbon, and yet there is an opportunity, which we're developing at scale now, to get farmers to help us keep carbon in the soil, as opposed to emitting that carbon in the way they do agriculture. Now, for them to change their approach, which is called regenerative farming, we realize that they need help. They need technologies, they need measurement approaches so that they could literally capture carbon, keep it in the soil, and then measure it, certify it, and then make that into a carbon credit. All of that value chain is something that Indigo invented and is actually now making available. Last year in 2022 was the very first time farmers benefited from being able to generate carbon credits through this program. That now has scaled to about 6 million acres of partners that we've successfully recruited into Indigo's plan. So you might say, this is going from molecular approaches to bacteria, to seeds, to carbon. And, we think that some of the big problems on the planet are going to benefit from the revolution that's going on in applied biology. And we and others are looking to make this impactful.
And Nubar, as we bring it back to human life, obviously neurodegenerative diseases, something that's near and dear to a lot of people. Talk about what you're doing with Denali Therapeutics and the impact that you're hoping to make and the investments in this space.
Denali is also at the forefront of that field. It's a company that we had the great pleasure of helping the team co-found and develop over many years. And they really, at a time when people had kind of given up on neurodegenerative diseases, they made some bold scientific leaps to really think about how to get medicines to where they need to act, particularly in the brain, and how to cross blood-brain barriers, and how to find the right targets to be able to address. It's very difficult. It has been difficult in neurodegenerative disease to identify unique targets that can be medicinally activated or deactivated. So Denali has has invested a significant amount of clinical infrastructure to be able to take multiple programs in the clinic. And we are quite hopeful that those programs, as they advance, will create a new generation of medicines that break open the neurodegenerative field. And we think that it's time that we do this. Patients have a desperate need for this.
Indeed. I do appreciate you joining us for this wide-ranging interview. It's been a pleasure. Noubar Afeyan, Moderna co-founder and flagship pioneering CEO, and Yahoo Finance's Anjali Kemlani. Thank you for your time this morning.
Thank you.
All right, now to an area of the market you might not be as familiar with, structured products. Now, they look to meet specific investor needs by providing investments facilitating customized risk-return objectives. Such products typically include a combination of assets linked to interest, as well as one or more derivatives. Yahoo Finance's executive editor, Brian Suzzi, sat down with DoubleLine structured products portfolio manager, Ken Shinoda. Now, they covered all things from the housing market to portfolio allocations in an exclusive interview at DoubleLine's Investor Day. Take a listen.
One of the main things to think about right now is adding more interest rate risk to your portfolio. We are seeing a big move higher in both short-term and long-term rates. Last year, the 10-year Treasury yield got all the way up to about 430 intraday, and we had a pretty significant rally, almost 100 basis points down to the low to mid threes. And we've backed up since. We're almost back to 4%. So I feel like for those that missed that last chance when we were up here around 4%, it's an interesting time to think about adding long-term treasuries as a protection hedge in your portfolio to, potential further slowdown in the economy or the recession that keeps being pushed out, right?
Yeah, the recession we've been hearing about for 2 years or so. How do you see a recession in the cards?
I think that the economy has been more resilient than I think the market expected. I think part of the reason for that is that so many consumers and companies locked in really low cost of financing through either mortgages at 3%, 30-year fixed rate mortgages at 3%, and or issuing corporate bonds into the market. And so the Fed raising short-term rates, that has a lag that we've all, everyone's talking about. I think that lag perhaps is longer than we had thought because of all this kind of low-cost fixed rate debt that's out there. So I think it's just taking more time than people had expected, but there's definitely signs of weakening. LEI, leading economic indicators, just came in negative again. I mean, it's been like 5, 6, 7 months of continuous negative prints. So I think the economy is slowing. It started with the housing market. That reacts the quickest to interest rates. You're seeing slowdown in hiring and even layoffs in finance and tech. So it's almost kind of like this rolling recession that's been happening through different pockets of the economy.
So if we are going to get rates 5.5, I've seen commentary now 6% or so, what ripple effects does that have in the mortgage market?
So the higher rates go, the higher mortgage rates are, the first thing that happens is that the affordability collapses. So we saw a 40% increase in home prices over the last 2 years. You combine that, we saw mortgage rates going from 3% in the summer of 2021 all the way up to 7.25% last year. Housing activity basically came to a halt. So all the data that's things like existing home sales, new home sales, mortgage applications, all that stuff came to a screeching halt. I think you're starting to see signs of life now in the housing market. You saw pending home sales tick up a little bit. What's happening is I think that buyers and sellers are coming to grips with reality, right? Sellers want yesterday's prices. They're realizing, okay, I'm not gonna get yesterday's prices. I gotta, lower my offer down 10%. And buyers are realizing, that crash in housing that I thought was gonna happen, is it gonna happen? Sorry, millennials, right? And so mortgage rates also came down a little bit, and I think people are starting to transact. And I think that's good for home prices. I think they keep falling a little bit, but we're not gonna see that global financial crisis type 20-30% down nationwide.
And we have to give kudos where kudos is due. You called the housing market correction. You didn't call it a catastrophe. But if rates do go close to 6%, is there a catastrophe?
Well, we were there. On mortgage rates, we were already at 7.25%. Yeah, so we're down. We're in the low 6s now. Yeah, I mean, the higher rates go, the more pressure it puts on housing. But the problem that you're seeing nationwide is really just a lack of supply, right? You don't have the forced selling like you had during the global financial crisis, and we have been underbuilding homes over the last 10 years. And so, even if you, wanted to buy a house, sometimes you can't even go find the one you want. So lack of supply and that demographic demand of millennials, second largest generation since the baby boomers, it's going to support housing. Can you see 20% declines in some places that were super hot, like here in Tampa, we're sitting here, but it was up 40%. So if you're, up 40 to 80% over 2 years and you correct down 20, it's not really the biggest deal unless you bought at the top. I think that's healthy for the housing market. It's a normalization. The post-COVID era just caused this crazy kind of bubble in a lot of assets, and I think housing is just coming back down to earth.
Is the housing correction over?
I still think it has room to run. There's a lot of new homes that were built, and I think that those homes need to get flushed to the market, and that's where the big discounting is going to come from. All the home builders saw the big run up in price. They all went out and started building supply to make profits off that run up in price. And now the supply is hit, but the demand is weak, and so they're going to have to cut those prices. So I think there's a little bit more room to run in the housing decline, but I think down 10% or so, a little bit more than that nationwide is probably where we shake out.
Is that 10% in prices?
10% in prices from the peak, which was last year. We're already down about 4%.
When do prices start to grow again?
I think rates stabilize here. I think they probably come down a little bit through the end of the year. Next year, the market's saying that the Fed's probably cutting next year now. It was thinking this year. And as interest rates come down and prices come down, affordability improves. And then I think you'll start to see home prices kind of flatten out again. There will be places that may not go down that much. There's places that could stabilize sooner because of demographic changes in demand. I mean, there's a lot of people that are coming down here to Florida. There's a lot of people moving to Texas. They're leaving high tax states like my wonderful California, that I love the weather, but I don't love the taxes. And so I think that, even if you go into a recession, there's still pockets of places in the US that still have this demographic shift that's moving and will create growth and job opportunities that are not going to get hit as hard.
There are a lot of average investors that consume the double line content and your views and thoughts on the Yahoo Finance platform. How do they go upon investing in what you're talking about? Is there a couple simple tips or a couple simple ways they can go about this?
Yeah, I mean, one thing you can buy is just good old-fashioned bond funds that have not been popular. Not the risky stuff, more of your kind of traditional core plus. The bond market's been beaten up. The average dollar price of the different indices out there are now kind of in the low 90s. They were in the mid 80s back in October. I mean, that's a lot of convexity in the bond market, everyone's favorite word, convexity, that hasn't existed for such a long time.
Let me Yahoo search that for a second.
Yeah, I'm teaching a class at USC, and that's one of the hardest concepts to teach the kids. But there's discounts everywhere in the bond market, so there's tons of opportunity. Rates have backed up to levels we hadn't seen in over a decade. You can buy high quality bonds with 5, 6, 7% yield. You can buy riskier bonds for 9, 10% yield. These are equity-like returns I'm talking about, right? And there was, the old Tina mantra, there is an alternative, which piled everyone into equities for the last almost decade. That's over. Fixed income can now provide yield, it can provide protection, I think. Last year was a very unique year where bonds and stocks went down together. Part of it had to do with inflation, part of it had to do with the Fed tightening. I think that the next time that we see a correction in equities, I think fixed income will do much better than it did than last year.
That was our Brian Sozzi there with Double Line Structured Products Portfolio Manager Ken Shinoda. Thank you so much. All right, coming up, we check in on the travel sector with the CFO of Wyndham Hotels and Resorts. Stick around. Wyndham seeing a big boost from post-pandemic travel demand in its earnings. The hotel and resort giant now looking to build out its footprint, capturing demand by adding more than one hotel every day of the year. For more, let's bring in Wyndham Hotels and Resorts Chief Financial Officer, Michelle Allen. Good to see you, Michelle. So talk about this growth, more than one hotel per day. How is this possible, especially when you look at things like currency concerns and inflation and things like labor shortages as well?
Great to see you, Rochelle. Thank you for having me again. Yeah, we are really happy with our performance this year. There's a strong interest for our brands from hotel owners and guests alike. And we've just seen incredible growth in not only our openings volume this year, but also in our pipeline, which is up 12%, which will eventually turn into incremental system growth for Wyndham.
So let's talk about some of these results. When we look at revenue per available room, grew 15% in the fourth quarter, 20% for the full year. Also saw particularly strong growth in the international market as well. What do you attribute that to?
We attribute to a few things. One, there's really strong leisure demand here in the U.S. There's continued occupancy recovery international, particularly in the European and Latin American regions for 2022. And then we've seen midweek business also improve pretty significantly, with our infrastructure category up double digits all year long in 2022. And of course, we're seeing some rate improvement with inflation being passed on in average daily rates to guests.
And I mean, we've seen domestic travel volume recover to about 96% of its pre-pandemic levels in 2022, according to the U.S. Travel Association. How is Wyndham positioning itself strategy-wise as we do have this roaring comeback?
Yes, we continue to make investments in digital innovation to meet our guests where they are, where their preferences are. They want to book online. They want to be able to check in and contactless solutions. They want the convenience of text messaging while they're on property. So the bunch of digital innovation projects that we continue to invest in to help drive incremental bookings to our franchisees and our hotel owners. And then in addition to that, we have a very strong media campaign and budget strategy to again meet guests where they are and where they want to be traveling.
And I want to talk business travel here because that hasn't recovered at the same rate as leisure travel. But it's interesting that you talk about infrastructure-related business travelers, not what you typically think of as your business traveler in a suit and tie. Talk about that aspect of the business and what that's doing for the business.
That's so true. Our business travel never stopped. Our business travelers wearing hard hats and work boots. They're not necessarily in suits and ties. And we've seen a double-digit increase in this type of business coming into our hotels in 2022. And that's a result of the investments that we're making to capture share. And that is all in anticipation of the significant spend we expect to be hitting the market beginning in 2023 from the new Infrastructure and CHIPS Act. So this is a trend that we expect to continue. Not only will we see the size of the pie increase, but we should also continue to see our capture rate of that pie increase.
And of course, we have to talk about things like headwinds. One of the industry challenges that Yahoo Finance spoke to with Marriott's CEO was talking about what they're seeing with trafficking issues there and sort of the role that hotels play. Just take a listen.
Yeah.
Human trafficking is a scourge on humanity, and unfortunately a lot of it happens using hotels as an environment. So several years ago we developed an intense training program for our associates, and as you point out, we've trained now 1 million Marriott associates. It's such a critical global issue that in partnership with the American Hotel and Lodging Association, we actually made the Marriott training available to all of our peers in the industry.
So what is Wyndham doing to combat this, being that this is something that does happen on a global coordinated scale?
Yes, this is an industry-wide issue. We are partnering with AHLA, just as Marriott is, and all of the peers are, to make sure the training is available to general managers, hotel owners, and staff at the hotels, and then a number of proprietary initiatives that we are deploying here within Wyndham to make sure that we are tracking and monitoring any type of complaints or indicators that would suggest there is is human trafficking at a property, and then we take it very seriously, and we have zero tolerance for human trafficking at Wyndham.
I do appreciate you commenting on that. Wyndham Hotels Resorts Chief Financial Officer Michelle Allen, thank you for joining me this morning. Right, next, stay tuned as we gear up for a conversation with the Ducati North America CEO. You won't want to miss this ride.
Check it out, everyone. After the call, coming at you. And guess what? The next company that we're going to be listening close to is NVIDIA. Julie, what are you going to be watching for?
I mean, they already are one of the original AI companies. You know they're going to talk about that buzzword somewhere along the way.
I'm going to be watching for those graphics processing units, the GPUs. Ladies and gents, boys and girls, tune in to After the Call. We break down all things NVIDIA.
Lots of things to watch after NVIDIA's earnings, so be sure to tune in after the call today. All right, well, let's focus on one aspect of NVIDIA where investors expect growth, and that's artificial intelligence. The AI boom important to both Main Street and Wall Street. Here with more, Yahoo Finance's Alexandra Canal. Hey, Ali.
Hey, Rochelle, and you're right. AI is going to be a big conversation for NVIDIA, especially as its gaming division has drastically slowed post-COVID, in addition to the fact that this company is also dealing with a lot of excess supply. Now, you've heard AI mentioned a lot over the past several weeks, especially due to the explosion of OpenAI's ChatGPT, Microsoft's Bing, all of this really adding to interest here. And this AI push benefits NVIDIA because these platforms require huge amounts of processing power. So NVIDIA's graphics cards are very well suited for those types of applications. Now, beyond just AI, this is going to be a very important element for Main Street as well, is the chip sector overall has been very cyclical in nature. So that means when the economy is doing really well, you usually see these stocks outperform. When the economy is doing not so well, that is a big drag. You can look at 2022 as a prime example there, obviously very terrible for tech overall. And at one point, NVIDIA stock was down over 60% compared to its 2021 record high. However, if you look at year to date in 2023, NVIDIA is up more than 40%. That's certainly going to have the bulls very excited. But I think an important part of the earnings call will be this commentary around the improving macro environment. Is this actually going to see an improvement over time? And if you take a look across the board, analyst recommendations there, Oppenheimer has an outperform rating, Morgan Stanley equal weight, Stifel, Hold, BMO Capital outperform. And like we said earlier, we're going to be breaking it all down this afternoon on Yahoo Finances after the call special, so be sure to tune in.
Looking forward to that. Yahoo Finance's Alexandra Canal, thanks so much. All right, gear up and roll on. Motorcycle maker Ducati still riding the pandemic highs, with demand still strong despite supply chain hiccups and consumer belt tightening. The performance-focused brand delivering sport innovations and newer engines, but how will their bikes hold up as e-bikes rise and market opportunities open up? Joining us now with more is Jason Chinook, Ducati North America CEO, and Yahoo Finance's Pras Subramanian. Pras, I've never been more jealous of you than at this time. I'm looking at these spectacular bikes here. So I want to talk about the design choice, starting with the new V4 engine in the 2023 Diavel model. Tell us more about this, Jason.
So Jason, Rochelle was asking about the new bikes we have right here, the Diavel V4, as well as the Multistrada V4. New bikes for you guys. What's customer reaction been like?
It's been incredible. In fact, the Diavel itself, the new V4, is an evolution of our design that we originally launched when we brought the Diavel out in 2010. It's a very unique model in the entire motorcycle lineup in the world, because it's this idea that we took a blend of a sport bike, a naked sport bike, and mixed it with a cruiser, which gives it this very muscular feel and appearance, but of course the performance you expect from a Ducati. So we've seen, while the bike hasn't actually been delivered in the market, we've seen customer order portfolio, which is basically how we predict our sales, been exceptional for this motorcycle. In fact, by far the best launch that we've had for a new model out of the Diavel lineup. And then for the Multistrada V4 Rally, this is a continuation of the Multistrada V4, which has been historically one of our top-selling motorcycles. And the idea behind the Rally is really to give the person who's the owner of this motorcycle an opportunity to go on and to travel the world. And as we've experienced a little bit in the post-pandemic life, people want to get out and ride. This is the bike that you can hop on, put your aluminum panniers, your passenger, and go have that adventure of a lifetime.
You know, so 2023 looking pretty strong with these two new bikes. 2022 is a record-setting year for you guys. What sort of powered that growth, and do you kind of see these trends happening this year as well?
I think a lot of it has to do with that post-pandemic effect that we've experienced, because people obviously were doing quite well financially and found themselves in a situation of like, I want to reward myself, I want to live life. And when they're going to do that, when they're going to seize it, they're doing it with a motorcycle. And when they make that decision for a motorcycle, they pick Ducati. We're at the top of the food chain, if you will, in the motorcycling community. But so our sales momentum has been very strong, both all over globally, but also in North America. And we delivered an exceptional result this last year. Unfortunately, behind Italy, we were number 2 globally, which is something that, you know, we're ready for the battle this year to be number 1. But it also, I think, was fueled by a lot of the enthusiasm for what we're doing in racing. I mean, this is the first time ever last year where we won the MotoGP Series Championship and World Superbike, and both of our riders in 23 are running with the number 1 plate all year long. And, you know, our Ducatisti, our clientele, they are enthusiasts about what we do racing-wise. So I think all of those things mixed together with the great product and just the market demand has been very positive.
So I want to get into racing in a little bit, but just we did note that there was some potential component issues, shortages. Did that sort of affect sales in the U.S., or was it kind of a non-issue?
Oh, I wish it was a non-issue for us. I mean, like, what ended up happening is we had 2 specific components early last year that slowed down our production. And we had a lot of bikes, what we call work in production. That basically means the entire motorcycle is there, assembled, waiting for one part. Mm-hmm. And that just slowed down for the first half of our year. What was incredible, though, is once that supply chain caught up, the momentum was right there. And we closed out last year, the second half of the year, with our best half year ever. And the great news is that momentum that we've built up is continuing. You know, there's always a risk if you make somebody wait too long that they just decide to not buy. But with the demand of our product and the fact that we keep evolving, we keep bringing out so many new models, we haven't seen a slowdown at all.
Yeah, even on the kind of these bikes are not cheap. So that buyer is still sort of hungry for these higher priced bikes?
Absolutely. In fact, what's the one thing when we look at the motorcycle market as a whole, you know, there's a lot of obviously concerns about what's happening in the economy right now. But the reality is at our price point being that ultra premium, we haven't really seen an impact with our clientele.
So real quick, I want to talk about racing real quick. You mentioned that doing well this year in MotoGP, but in Moto E, I believe, right? Is that what they're calling the electric racing series that you guys are going to be the single make manufacturer for?
Yes.
I wanted to ask you about that. That's going to happen this year, but we're eventually going to see some of these potentially electric bikes coming in the future. Are customers excited about that future?
Yeah, in fact, this is, there's a lot of people have been asking us about our electrification strategy. And before we jump into the racing part of it, really our objective is not necessarily to check the box to build an electric motorcycle. It is, what can we do to reduce our carbon footprint as a brand? And electrification is one of those methods. We have other options as well, but that's one of the methods that actually seems to be the most predominant right now. And what we saw is, how are we going to do this? We're going to deliver an experience that people expect from a Ducati, to do that at the highest level. And the highest level for us is racing. That's part of our DNA as a brand. And so we are the sole supplier of the Moto E series, as you mentioned, and we just finished the production of all the Moto E bikes that will actually start the race series next year. And our objective is to take the technology of what we learn from this series at that level and find a way to distill it down to what we can bring to, let's say, our client level. And we have a lot of excitement behind it. Unfortunately, the race series won't come to North America until hopefully next year. But we're encouraging and driving that because it's very exciting to see this evolve in racing.
I want to see these e-motorcycles on Daytona next year, hopefully. So Jason Chinnick, thanks so much for joining us. Really appreciate it.
It's my pleasure, Pras.
Back over to you, Rochelle.
All right, thanks so much. Yahoo Finance's Pras Subramanian there with Jason Chinnick, Ducati, North America's CEO. Thank you both. All right, coming up, olive oil in your coffee. Stick around as we discuss the latest product from Starbucks. Starbucks is out with a new creation, olive oil-infused coffee. Now, the company is calling it Starbucks Oleato. Brooke De Palma is here with the details. A curious development here, Brooke.
Very, very curious. It has the internet buzzing. Of course, oleato means oil. So Starbucks essentially introducing Starbucks with olive oil here. Now, this is part of a three-part lineup. It'll include both cold and hot beverages, all infused with a spoonful of extra virgin olive oil that's made from a family producer in Sicily, Italy, in Partana, Sicily, Italy. That is the name of the olive oil that they're using as well. It includes a cafe latte, an iced shaken espresso, and a golden foam cold brew. They said that this combination of the coffee with the olive oil creates a velvety, rich, buttery texture that pairs well with the chocolate notes of the coffee. They are also calling this a completely new genre and calling it the next revolutionary coffee ritual. Crazy to believe there, but it'll debut in 25 stores in Italy. That's all their stores there. It'll then be available in Southern California later on this spring, and then it'll also be available in the Middle East, Japan, as well as the United Kingdom later on this year. Now, this is a big bet for them, but they say that it's going to be just as big as the debut of the latte, the PSL, as well as the nitro cold brew, and the more recent introduction of the ice shaken espresso. It really seems like it's a culmination of Howard Schultz, of course, the interim CEO's 40-year career in coffee. He said that this genre and the excitement that he has around it reminds him of the first time that he went to Milan, Italy back in 1983, where he decided that it was time to bring handcrafted espresso to Starbucks and to America. It also comes at a time where he is set to step down for the third time as interim CEO. Laxman Narasimhan, the interim, or rather the incoming CEO, will take the helm there. And also comes at a time where customers love to modify their coffee. Modifications were up 28% here in the U.S. year over year with the addition of syrups coffee. So definitely be interesting to see how it does. Certainly a new genre for Starbucks and perhaps a new genre for consumers overall as well.
I mean, I'm definitely intrigued there. All that velvety, buttery goodness. See, just when I say no, I'm going to be good with my budget, not spend more on coffee, they pull you back in. It sounds good, though. Brooke DePalma there, thank you so much for that. All right, well, let's do a final check of the markets as we head into the noon hour. As we saw, it was in negative territory this morning and then shifted into the positive, still staying there, but just barely. The Dow up there just by about 30 points, they're about 0.1%. The S&P up just barely, about 1.5 points. And the tech-heavy Nasdaq there up about 10 points on the day as we await the details of those FOMC minutes and get that determination between a 25 and 50 basis point hike. That'll do it for now. I'm Rochelle Akufo. I will be back at 11 a.m. Eastern. I'll see you then.